In Chapter 3, we talked about the need to apply for a license if you want to engage in SFC, Securities and Futures Commission regulated activities, and we also introduced the licensing system of the SFO, Securities and Futures Ordinance, including types of regulated activity, the single license regime, and who can obtain licenses or registrations, etc. If you don't remember, you can go back and watch the previous video to review. Apart from these, what else does the licensing system of the SFO stipulate? If you are an AFI, authorized financial institution, and want to engage in regulated activities, you need to register as a registered institution. Do you still remember what a registered institution is? It's an authorized financial institution approved by the HKMA, Hong Kong Monetary Authority, and engaged in activities regulated by the SFC, mainly banks. Are there any special circumstances where AFIs can engage in regulated activities without registering as a registered institution? Yes. If an AFI is engaged in Type 3 or Type 8 regulated activities, they can be exempt from registration requirements and don't need to apply to become a registered institution. Registered institutions must comply with the Banking Ordinance and appoint at least 2 executive officers to be responsible for directly supervising its regulated activities. What conditions must an individual meet to engage in regulated activities for a registered institution? First, his name is entered in the register maintained by the HKMA, Hong Kong Monetary Authority. In other words, this person is a recognized person by the HKMA, and his personal information can be found in the register held by the HKMA. Secondly, in the register of the HKMA, it must show which registered institution this person is working for and engaged in a certain type of regulated activity. For example, let's say my name is Peng Yifang, and I want to represent Hang Seng Bank to help customers buy and sell securities products or provide advice. Because buying and selling securities products is a regulated activity, I need to first get the approval from and register with the HKMA, Hong Kong Monetary Authority, before I can engage in the buying and selling of securities products. Once I get the approval of the HKMA and register successfully, my name, Peng Yifan, will be displayed on the HKMA's Register of Securities Staff of AIs. At the same time, it will also show that I represent Hang Seng Bank in engaging in the first and fourth types of regulated activities. Not only can I help customers buy and sell securities, but I can also provide advice on securities. In this situation, since I have successfully registered with the HKMA, can I also represent Citibank to help customers buy and sell securities? That's not possible. The HKMA's register shows that Peng Yifan is currently only representing Hang Seng Bank to buy and sell securities for customers, and there is no Citibank. If I represent Citibank to help customers buy and sell securities, it would be an offense. The SFO, Securities and Futures Ordinance stipulates that if a person wants to carry out regulated activities on behalf of his principal, he needs to obtain a license. Do you still remember what a principal is? It refers to the one who places orders and pays for others to work, similar to the role of an employer. Usually, a licensed representative is affiliated with a principal, meaning working for a boss. Why is that? In theory, as long as the SFC, Securities and Futures Commission approves, a licensed representative can be affiliated with more than one principal. However, since the licensed representative represents the company, when they are affiliated with more than one principal, there may be potential conflicts of interest, legal liabilities, and other issues. To avoid these problems, licensed representatives usually only belong to one principal. In this way, multiple licensed corporations can exist within the same company group. Similarly, as long as the SFC approves, a licensed representative can be affiliated with different licensed corporations within the same company. How can a licensed representative become a responsible officer? A licensed representative carries out supervisory functions for a licensed corporation and also needs to be nominated by the licensed corporation and apply to the SFC. Once approved by the SFC, they can officially become a responsible officer. The SFO, Securities and Futures Ordinance, has other requirements for licensing and registration, including: first, allowing licensed persons conducting some regulated activities to conduct certain others. What does this mean? It means that as long as certain conditions are met, one can engage in that type of regulated activity without a license for that activity. Suppose I have a Type 1 license. Theoretically, I can only engage in Type 1 regulated activities, that is, dealing in securities. However, when I'm helping a client buy and sell securities, the client might ask me for some advice on securities. I don't have a Type 4 license. Does this become a violation? Actually, this provision provides some flexibility. As long as the advice I provide about securities meets the requirement of being wholly incidental to the securities transaction, I can engage in Type 4 regulated activities without a Type 4 license, so there is no need to specifically apply for a related license. Second, the SFC, Securities and Futures Commission, can grant temporary and provisional licenses to cover the period before the decision on a licensing application is finalized by the SFC. Third, if you want to become a substantial shareholder of a licensed corporation, you also need the approval of the SFC. Fourth, the San Francisco Airport establishes guidelines for fit and proper. Individuals or companies applying for licenses or registration must meet the requirements of the fit and proper guidelines. Fifth, it restricts the use of certain titles by unlicensed persons. If you are not a licensed person, you cannot call yourself titles such as stockbroker. Sixth, the SFC may impose any conditions on the licenses it issues. What are some examples? For instance, it can limit the clients that certain licensed corporations can serve, such as only professional investors. Not everyone can open an account or buy securities products at this company. The reason for this condition is because the SFC has more protections for retail investors, and these companies do not intend to provide comprehensive protection for retail investors, so the SFC adds conditions to their license, limiting their service range. Moreover, it can limit the business that licensed corporations can conduct, requiring them not to hold client assets or not to provide discretionary management of collective investment schemes, etc. If there are no conditions imposed on the license issued to the company, the condition part of the public register of the SFC will be shown as none. So, what are the responsibilities of the board? The board is ultimately responsible for the conduct, operations, and financial soundness of the intermediary. If the intermediary needs to apply for a license, the board of directors should also be appropriately involved. For example, the SFC, Securities and Futures Commission, will require the intermediary to submit data on the firm's management and key human resources, and the board should also appropriately participate. The board also needs to confirm the requisite information, such as an organizational chart showing the relevant reporting lines. Since the board can delegate decision-making power to senior management, can they say, "This isn't my responsibility," and directly pass the buck to this group of managers? No, the board has a responsibility to supervise how senior management uses their power. If problems arise, the board must take responsibility. And the SFO, Securities and Futures Ordinance, the term executive officer has different definitions, which we need to pay attention to. If we're talking about a licensed corporation, the so-called responsible officer refers to the person in charge of the corporation. If we're talking about a registered institution, it refers to the executive officer of that registered institution. Moreover, if it's an associated entity of an intermediary, it refers to the director who is responsible for directly supervising that entity. This director is not a responsible officer, so don't get confused. As mentioned before, an associated entity refers to a company in a controlling entity relationship with an intermediary, and it is a company in Hong Kong that receives or holds in Hong Kong client assets of the intermediary.
It's so confusing.
Executive officers and responsible officers, what's the difference between them? Regardless of which one, they actually refer to the key management personnel responsible for regulation in the institution. The study manual mainly focuses on responsible officers of licensed corporations and executive officers of registered institutions. Their roles are similar, but there are still some differences. In this section, we will discuss the differences between the responsible officer and the executive officer. You might say, isn't the name the biggest difference? One is called a responsible officer, the other is called an executive officer. Yes, the names are indeed different, and both types of people are responsible for participating in and supervising regulated activities, in other words, compliance work. They just serve different institutions and are called differently. They are both scapegoats. The responsible officer is the scapegoat for the licensed corporation, and the executive officer is the scapegoat for the registered institution. In terms of appointment, the responsible officer is appointed by the licensed corporation and approved and supervised by the SFC, Securities and Futures Commission. The executive officer is appointed by the registered institution and approved and supervised by the HKMA, Hong Kong Monetary Authority. Their duties are actively participate in or supervise regulated activities. So how many scapegoats are needed when a company conducts regulated activities? According to regulations, each licensed corporation must appoint 2 responsible officers. Among these 2 responsible officers, at least one must be an executive director of the corporation. If the licensed corporation has more than one executive director, every individual executive director of the licensed corporation is approved as a responsible officer. For each type of regulated activity, at least 2 responsible officers are required. One of them must be based in Hong Kong and at all times able to supervise how the licensed corporation conducts regulated activities. If the licensed corporation conducts more than one type of regulated activity, can the aforementioned 2 responsible officers be reused? Yes, you can reuse the 2 responsible officers. Recycle and reuse, save money and energy. As for registered institutions, it's the same. Remember, each regulated activity must have 2 executive officers, and at all times there must be at least one executive officer available to supervise the business of the regulated activity. Do responsible officers have to be directors? Let me show you again here. Well, remember, the smaller circle in the picture represents the executive directors, while the larger circle represents the responsible officers. So, responsible officers can be executive directors, but responsible officers are not necessarily executive directors. However, executive directors must be responsible officers. What are responsible officers? They are the scapegoats of licensed corporations, responsible for supervising the business of the regulated activity of the licensed corporation. Is that clear? In terms of who should be responsible officers, the SFC, Securities and Futures Commission, actually has expectations, with 2 types of people. The first type is those who are responsible for the overall management oversight function of the licensed corporation. These individuals are responsible for supervising and managing the entire operation of the corporation and have a deep understanding of the company's daily operations. The second type is those responsible for key business line functions. What are the key businesses? For example, they are specifically responsible for directing and overseeing a line of business, understanding the regulations and supervision of these businesses, so as to ensure that business operations are compliant. So, you will see that the SFC's preferred candidates of responsible officers are those in charge of core functions of a corporation. So who can become a substantial shareholder of a licensed corporation? Remember, no one can become a substantial shareholder of a licensed corporation without the approval of the SFC, Securities and Futures Commission. If you want to become a substantial shareholder of a licensed corporation, you must obtain the approval of the SFC. Why? Because substantial shareholders are special, they hold more equity interests, have greater influence on the company, and therefore are subject to more regulation and scrutiny. For this reason, to become a substantial shareholder, you must be approved by the SFC in advance. So how can one be considered a substantial shareholder of a licensed corporation? The SFO, Securities and Futures Ordinance clarifies 3 situations, and as long as one meets any of these conditions, we consider them a substantial shareholder. The first situation, if a person has an interest of more than 10% of the total number of issued shares of the corporation, he is considered a substantial shareholder of the licensed corporation. Well, you can look at the chart on the right. For example, Mr. Gao directly holds 10% of the shares of Kaohsiung Securities, so Mr. Gao is a substantial shareholder of Kaohsiung Securities. In the second situation, if someone directly or indirectly holds more than 10% of the voting power of a corporation, we can consider them as a substantial shareholder. You might wonder, how can someone indirectly hold the voting power of a corporation? If Mr. Gao indirectly holds shares of Kaohsiung Securities through a company, would he be considered a substantial shareholder? Having voting power in a corporation usually means owning shares of that company. In most cases, each share represents one vote, such as common stock. If Mr. Gao directly holds 10% of the common stock of Kaohsiung Securities, he has 10% of the voting power, making him a substantial shareholder of Kaohsiung Securities. Furthermore, if you indirectly hold more than 10% of the voting power of a corporation through a wholly owned company, you are still considered a substantial shareholder of that company. Now let's look at the diagram on the right-hand side. In this example, Mr. Gao holds 100% of the Gao Family Trust, which means he fully owns the Gao Family Trust. At the same time, you can see that the Gao Family Trust also holds 10% of the voting power of Kaohsiung Securities. Therefore, the Gao Family Trust is indeed a substantial shareholder of Kaohsiung Securities. So, how does Mr. Gao become a substantial shareholder of Kaohsiung Securities? Because Mr. Gao holds 100% of the shares of the Gao Family Trust, he becomes the controller of the Gao Family Trust, meaning he can indirectly control 10% of the shares of Kaohsiung Securities through the Gao Family Trust. Therefore, Mr. Gao is also a substantial shareholder of Kaohsiung Securities. Are there any other ways to become a substantial shareholder of a corporation? Yes, it is possible to become a substantial shareholder by exercising at least 35% of the voting power of another corporation at a general meeting, which in turn has more than 10% of the voting power of the corporation at a general meeting. You can look at the illustration on the right-hand side. First, Big Drink holds 10% of the voting power of Kaohsiung Securities. Second, Mr. Gao holds 35% of the voting power of Big Drink. In this situation, Big Drink is a substantial shareholder of Kaohsiung Securities. Why? Because it holds 10% of the voting power of Kaohsiung Securities. As long as Mr. Gao continues to hold no less than 35% of the voting power of Big Drink, and Big Drink also holds 10% of the voting power of Kaohsiung Securities, both Big Drink and Mr. Gao are substantial shareholders of Kaohsiung Securities. In summary, if you want to become a substantial shareholder of a licensed corporation A indirectly, you need to hold no less than 35% of the voting power of another corporation B, and at the same time, Corporation B must hold 10% of the voting power of the licensed corporation A. Only then can you become a substantial shareholder of licensed corporation A through Corporation B. Important matters should be discussed 3 times. Registered institution is an important concept. Although everyone may be familiar with it, let's review it together. Do you remember what a registered institution is? A registered institution is an AFI, authorized financial institution that engages in regulated activities, specifically securities and futures business. What does it mean to be an AFI? In simpler terms, it refers to banks that are regulated by the HKMA, Hong Kong Monetary Authority. If these banks want to engage in securities and futures business, what do they need to do? First, they need the approval of the HKMA, and then they have to register with the SFC, Securities and Futures Commission. Okay, so let me ask you, if these banks don't intend to engage in securities and futures business, do they still need to register? No, they don't need to register in that case. Who regulates the registered institutions then? Remember, nominally, registered institutions are jointly regulated by the HKMA and the SFC. However, the HKMA is the frontline regulatory authority for registered institutions. When the HKMA regulates registered institutions, it adopts the regulatory standards set by the SFC, such as the fit and proper criteria. Let's test your knowledge again. Do AFIs necessarily engage in securities and futures businesses? No, AFIs do not necessarily engage in securities and futures businesses. Those that definitely engage in securities and futures businesses are called registered institutions. Moreover, these registered institutions also have bank-related businesses. So, I want to ask, does anyone know what securities and futures activities do not require a license? It turns out that some individuals or institutions can be exempted, meaning they do not need a license to engage in certain regulated activities and will not be considered as a violation. So who can enjoy this privilege without needing a license? There are 5 types of people, including certified public accountants, solicitors, counsel, trust companies, or companies that only serve wholly owned subsidiaries, parent companies, and affiliated companies. These individuals or institutions can engage in certain types of regulated activities without a license. What types of regulated activities are there? The main activities are those that provide advice, including Type 4, advising on securities, Type 5, advising on futures contracts, Type 6, advising on corporate finance, Type 9, asset management. The above-mentioned 5 types of people, when engaged in these 4 types of activities, do not need a license. Why do these 5 types of people have this privilege? What conditions must be met to do so? Well, you'll notice that the exempted individuals or institutions are all professionals. They must carry out activities based on their professional status in order not to require a license. For example, a lawyer may be helping a client with estate matters and may need to provide advice on those matters, such as, the client needs to sell some securities to fulfill the will. In this situation, the lawyer provides advice on securities transactions based on their work in handling the estate. The lawyer's unlicensed conduct of this regulated activity is entirely incidental to their professional work in handling the estate, so there's no problem. However, if a lawyer charges fees solely for securities and futures advice, it is not a regulated activity carried out entirely incidental to their professional status. For example, if a lawyer puts up a sign saying, "Stock consultation service, inquire about stock rise and fall, fee 5,000 Hong Kong dollars. In this case, the lawyer is not conducting regulated activities due to their professional status and needs to apply for a license or registration with the SFC. There is no exemption. In short, the 5 professional individuals or institutions can be exempted when engaging in Type 4, 5, 6, and 9 regulated activities. They don't need to obtain a license and can still carry out securities and futures trading activities. The condition for exemption is that these individuals carry out regulated activities as an incidental to their professional status. If they conduct these regulated activities independently, it would be an offense, and they need to obtain a license first. Wow! Buy one get one free. Apply for a license and cover other types of regulated activities. So, what's the big giveaway? Well, it's not really a giveaway. As we mentioned before, if you engage in any type of regulated securities and futures activities, you need to obtain the corresponding license. So what does buy one get one free mean? For example, if you currently only have a Type 1 license for dealing in securities, when you help clients buy and sell securities, they may ask for your advice on securities, which falls under Type 4 advising on securities. In this case, your advice is based entirely on assisting the client with securities transactions, which means the Type 4 activity is entirely incidental to the Type 1 activity. In this case, you can be exempted, and even without a Type 4 license, you can engage in Type 4 activities without committing an offense. However, if you want to make Type 4 activities a standalone business, you'll need a license. Why? Because you want to engage in Type 4 activities independently, not as a result of Type 1 activities, and you only have a Type 1 license. So, you'll need to get a Type 4 license. So, does every license come with a giveaway? No, the SFO, Securities and Futures Ordinance specifies the regulated activities that correspond to each license and their exemptions. You can refer to this green table, which clearly states what's included. If you have a Type 1 license, dealing in securities, you may need to engage in Type 4 and Type 6 regulated activities, such as providing advice on securities and corporate finance to clients for securities transactions. Alternatively, you may need to engage in Type 8 or Type 9 activities, securities margin financing or asset management to help clients buy or hold securities. These Type 4, 6, 8, and 9 activities are all incidental to Type 1 activities and are exempt. If you have a Type 2 license, dealing in futures contracts, you may need to engage in Type 5 and Type 9 regulated activities, such as providing advice on futures contracts and asset management, as a result of your Type 2 activities. These activities are also exempt. If you have a Type 4 license, advising on securities, you may introduce clients to brokerage firms for transactions, meeting the elements of Type 1 activities, and can also be exempted. If you have a Type 6 license, advising on corporate finance, you may be involved in some securities transactions. For example, you may tell a client, "Hey, if you buy more of this stock, you'll trigger a mandatory takeover offer, so you need to sell some." In this case, the Type 1 activity is exempt. If you have a Type 9 license, providing asset management, you naturally give advice and help clients trade, right? Type 1, 2, 4, and 5 activities that are entirely incidental to Type 9 activities do not require a license. Remember, the key phrase is entirely incidental. As long as your Type 1, 2, 4, and 5 activities are derived from the Type 9 activity, you don't need to obtain additional licenses. As a licensed representative, what should I do if I resign or want to work for other companies after obtaining my license? Remember, when a licensed representative leaves their job, the licensed corporation must notify the SFC, Securities and Futures Commission, within 7 business days of the resignation. If the licensed representative can move to another licensed corporation within 180 days, this is called a license transfer, and there is no need to reapply for the license. On the other hand, if the licensed representative can't find employment with another licensed corporation within 180 days, their license will be revoked. Now, let's test your understanding. Mr. Gao is a licensed representative employed by Sun Hung Kai Securities and resigns on April 30, 2022. What is the first thing that needs to be done? Within 7 days of Mr. Gao's resignation, Sun Hung Kai Securities needs to notify the SFC. Alright, as time flies and 180 days have passed, Mr. Gao hasn't found another licensed company to work for by October 28, 2022. What will happen? Mr. Gao's license will be revoked. At this point, you might think, what? After all the hard work and effort I put into obtaining my license, it turns out that if I can't find a new employer within 180 days of leaving my job, my license will be revoked. If I want to continue working in this industry, do I have to take the exam again? Well, indeed your license will be revoked after 180 days. However, if you re-enter the industry within 8 years, you won't need to retake the examination, you'll just need to apply for the license from the SFC again. Note that the SFC may have additional requirements for you depending on how long you've been out of work, such as additional CPT, continuous professional training hours. Remember, this rule applies not only to licensed representatives but also to relevant individuals of registered institutions, i.e., employees engaged in regulated activities employed by registered institutions. Their roles are similar to those of licensed representatives. However, for such individuals, when they leave their job, it should be the registered institution notifying the HKMA, Hong Kong Monetary Authority, not the SFC. So, let's talk about the differences between temporary licenses and provisional licenses. What exactly is a temporary license? Well, remember that temporary licenses are mainly for foreigners. What is a foreigner? It means temporary licenses are for corporations which principally carries on its business overseas, allowing them to conduct short-term transactions in Hong Kong. Generally speaking, the validity of a temporary license does not exceed 3 months, and within 24 months, the total time of holding such licenses cannot exceed 6 months. In other words, you can only get 2 temporary licenses within 2 years. After obtaining this temporary license, you can conduct regulated activities in Hong Kong. So, what types of activities are there? These include types 1, 2, 4, 5, 6, 10, etc. Type 1, dealing in securities. Type 2, dealing in futures contracts. Type 4, advising on securities. Type 5, advising on futures contracts. And Type 6, advising on corporate finance. If you've noticed, there are several types of regulated activities that cannot be done, including 3, 7, 8, 9. Why? Because types 3 and 8 involve borrowing money and leverage, so they can't be done. Type 7 provides automated trading services, which may involve some infrastructure and take a longer time, so this activity is not allowed. Type 9, asset management, is also considered a long-term business, so it can't be done either. So, what is a provisional license? Well, provisional licenses are completely different from temporary licenses. Provisional licenses are mainly provided for individuals or corporations that have already applied for a formal license. The purpose is to allow applicants to use it temporarily before the formal license is issued. Therefore, the provisional license is valid until the SFC, Securities and Futures Commission, makes a final decision on the representative license application. That is, once the SFC issues the result of the application, whether it approves or rejects the license application, the provisional license will be revoked. Basically, the provisional license applies to all regulated activities because it is only provided for those who are applying for a formal license to use as a provisional license. Remember, if you haven't obtained a license or registered, you cannot claim to be a bond broker, bond dealer, securities dealer, stock dealer, or stockbroker. The SFO, Securities and Futures Ordinance, specifies that these titles cannot be used casually. If you're interested and want to know what titles can't be used, you can refer to the complete list in the SFO. If you want to know how to apply for a license, what are the requirements, or related matters, you can go to the SFC, Securities and Futures Commission's website and download the licensing handbook. The SFC will update the contents of the manual from time to time, and if you are interested, you can go and have a look yourself. The fit and proper guidelines is a very important concept, and it appears frequently in other chapters as well. So, what is fit and proper? When a company or an individual applies for a license or registration, the SFC, Securities and Futures Commission, or the HKMA, Hong Kong Monetary Authority, will determine whether the applicant is fit and proper. It's like when your daughter is about to get married and brings a boy home, you have to determine whether this boy is fit and proper to be your son-in-law, considering his looks, character, financial status, and whether he meets the criteria to be your son-in-law. The fit and proper guidelines is a set of rules that primarily specify the requirements that a fit and proper person must meet, and it applies continuously to applicants, licensed and registered persons. So when should you comply with the fit and proper guidelines? As mentioned earlier, these guidelines continuously apply to applicants, licensed and registered persons. In other words, whether you are applying for a license, or you have already obtained a license and become a licensed or registered person, you must continuously meet the requirements of the fit and proper guidelines. So let me ask you, do registered institutions under the HKMA need to comply with the requirements of the fit and proper guidelines? Of course, they must comply, because the fit and proper criteria apply to both individuals and companies. What about licensed corporations? They also need to comply. As long as you are an applicant or already acting as a licensed representative, licensed corporation, registered representative, or registered institution, you must meet the requirements of the fit and proper guidelines. So who is responsible for monitoring compliance with the fit and proper requirements? Both the HKMA and the SFC will be monitoring. The HKMA mainly monitors AFIs, authorized financial institutions, including whether their managers and employees meet these requirements. As for other persons, they are subject to monitoring by the SFC. For individuals, such as licensed representatives, responsible officers, and registered representatives, what are the requirements to become fit and proper? The SFC, Securities and Futures Commission, or the HKMA, Hong Kong Monetary Authority, will consider the following points. First, financial status or solvency. The SFC or the HKMA will consider whether you have filed for bankruptcy. If you are currently involved in bankruptcy or similar proceedings, or recently discharged from bankruptcy, or failed to meet a judgment debt, it reflects that your financial situation is not sound, and you are not fit and proper. Second, competence and capability. You must be at least 18 years old, have the appropriate education and experience, such as relevant industry experience and sufficient training. These factors will be considered. If you want to know the required education or experience, you can refer to the SFC's Guidelines on Competence, which details the qualifications for competence. Third, character and integrity. Integrity refers to whether you have engaged in fraud or dishonest behavior. Character does not refer to your personality but whether you have committed an offense, such as the regulations of the SFC, or public reprimands, whether you have been disqualified by the court from acting as a director, whether you have ever served as a director or shareholder of an insolvent corporation. These aspects are used to judge whether you are capable and honest in carrying out regulated activities and whether you are reliable. If you experience negative situations, it may result in suspension or disqualification of your license. For corporate applicants or intermediaries, what are the requirements to become fit and proper? It is very similar to individual applicants. The SFC, Securities and Futures Commission, or the HKMA, Hong Kong Monetary Authority, will consider the following points. First, financial status or solvency. The SFC, or the HKMA, will consider whether the intermediary meets capital requirements and whether your company's finances are sound. If you are a licensed corporation, you need to meet the capital level of the FRR. Financial Resources Rules. If you are a registered institution, you need to meet the capital adequacy requirements of the HKMA. Like individuals, your company cannot be bankrupt or have failed to meet a judgment debt. Therefore, financially, it is about considering whether the intermediary has the ability to maintain its operations. Second, competence and capability. Intermediaries need to meet the abilities specified in the Guidelines on Competence, including having a proper business structure, sound internal control, and risk management systems. Additionally, they will consider whether the intermediary has competent personnel, meaning the staff has received sufficient training. Third, character and integrity. Like individuals, intermediaries also need to have a good reputation, meaning no fraudulent or dishonest behavior. They need to have a good character, in other words, whether they have committed offenses, such as violating regulations of the SFC, whether they have been sanctioned or disciplined by professional organizations or regulatory authorities, whether the directors have been disqualified by the court, or whether the company management has ever served in the management of an insolvent company. The main assessment will be whether the intermediary is reliable, capable, and honest in carrying out regulated activities. Like individuals, if you encounter negative situations, it may result in suspension or disqualification of licenses. The Sponsor Guidelines. With the full name, Additional Competence Requirements for Corporations and Individuals Engaging in Sponsor and Compliance Advisor Work. From the name, you can probably guess what it is about. If you are engaged in sponsor or compliance advisor work, whether as a corporation or an individual, in addition to the fit and proper guidelines, You must also meet the eligibility requirements listed in the Sponsor Guidelines. If you are not a sponsor or compliance advisor, do you need to comply with this regulation? No, you do not need to. If you are engaged in the work of sponsor or compliance advisors, in addition to the Fit and Proper Guidelines, you need to meet the qualification requirements listed in the Sponsor Guidelines. What are the differences between sponsors and compliance advisors? Why does the SFC, Securities and Futures Commission, have particularly high requirements for them? Sponsors and compliance advisors are both engaged in Type 6 regulated activities, which is advising on corporate finance. Moreover, they are appointed based on the listing rules. When a company prepares to apply for listing, they can appoint a sponsor. What is a sponsor? It is a corporation that specializes in assisting companies in applying for listings, ensuring that these companies meet the listing requirements and can go public smoothly. When the company successfully goes public and completes the initial public offering project, it will then appoint a compliance advisor. Compliance advisors mainly help listed companies meet current compliance requirements, develop compliance plans, and meet the requirements of the exchanges and the SFC. In short, sponsors are mainly responsible for pre-listing work, assisting companies in applying for listing and ensuring that companies meet regulatory requirements. Compliance advisors are mainly responsible for post-listing work, ensuring that companies meet regulatory requirements after listing. Apart from complying with the competency requirements, sponsors and compliance advisors need to comply with other regulations. Firstly, sponsors are required to have at least 2 principals appointed by the firm to be in charge of the supervision of the transaction team at all times. As the transaction team is responsible for executing listing matters, such as involvement in key decision-making, risk management, etc., it is crucial. Who should serve as the principals? If the sponsor is a licensed corporation, responsible officers should be appointed as principals. If the sponsor is a registered institution, it should be an executive officer. In addition, the principals must also meet the eligibility options stipulated in the sponsor guidelines. There are eligibility options, and it is sufficient to satisfy one of them. If you are interested, you can download the sponsor guidelines from the SFC, Securities and Futures Commission website and refer to Appendix A for details. Secondly, sponsors must meet the minimum capital requirement, including a minimum paid-up share capital of 10 million Hong Kong dollars at all times. Thirdly, individuals engaged in sponsor work need to meet additional CPT, continuous professional training requirements. The training needs to be relevant to the work of the sponsor, such as related skills, relevant regulatory rules and their updates, etc., and meet the specified hours to comply with the CPT requirements. Regarding the details of CPT, we will introduce the guidelines on CPT from the SFC later and explain in detail for everyone. The above are additional requirements for sponsors. So what about compliance advisors? All compliance advisors must always meet the qualifications to serve as sponsors, so they can qualify as compliance advisors initially and continue to qualify in the future. If they no longer meet the qualifications to serve as sponsors, they can no longer serve as compliance advisors. TC Advisor Guidelines, as you can see, has a long full name. Knowing the TC Advisor Guidelines alone is sufficient. There are 2 abbreviations. The first one is called Codes, which refers to the Takeovers Code, and the Share Buybacks Code. The second abbreviation is called the Codes on Takeovers, which combines the 2 codes into one. If you are a corporation or an individual providing advice on matters or transactions regulated under the Codes on Takeovers, in addition to the Fit and Proper Guidelines, you must also meet these additional competence requirements. So, who would provide advice on matters or transactions within the scope of the Codes on Takeovers? There are 2 types of individuals. The first type is TC advisors. Who can be an advisor? It is a corporation holding a Type 6 regulated activity license, which provides advice on transaction activities under the codes. The second type is TCROs. What's different about them compared to TC advisors? They also need to hold a Type 6 regulated activity license, but they act independently as individuals, providing advice on transaction activities within the scope of the codes. In addition to general competence requirements, the above individuals also need to comply with certain rules, including, at least one TCRO must supervise and be involved in each transaction subject to the codes the TC advisor is advising on. Moreover, whether you are a TCRO or a licensed representative of TC advisors, as long as you are an individual providing advice on matters or transactions within the scope of the codes, you must meet additional eligibility and CPT requirements. The government often promotes the idea of self-enhancement. Even if you are a temporary actor, you should still read Self-Cultivation for Actors. Regardless of whether you are a licensee or a registered person, after obtaining a license, you need to undergo continuing education. The SFC Securities and Futures Commission also has guidelines on CPT, which requires licensees and registered persons to undergo regular training to enhance their technical skills, professional expertise, ethical standards, and regulatory knowledge. The goal is to foster the fitness and properness of the licensed or registered persons. As for the training requirements, topics, or formats, we will explain them in more detail later on. Remember, after we obtain the license, it doesn't mean we are completely settled. According to the requirements of the SFC, Securities and Futures Commission, we still need to participate in CPT, continuous professional training every year. Different types of individuals require different contents of CPT, so pay attention to which types you belong to. If you are a licensed representative, you must participate in at least 10 hours of CPT every year. Regardless of how many or what type of regulated activities you engage in, you must participate in at least 10 hours of training. If you also serve as a responsible officer or executive officer, you must participate in at least 12 hours of CPT each year. You will see that this is 2 hours more than the licensed representative. Why the additional 2 hours? It's because they have greater responsibilities, so the SFC requires them to spend an extra 2 hours on regulatory compliance-related training. For individual practitioners, which refers to all licensed persons engaged in regulated activities. If you want to maintain the license, you need to complete at least 5 hours of CPT every year, and these 5 hours of training topics must be directly relevant to the regulated activities in which he or she is licensed at the time the CPT hours are undertaken. And if you are an individual practitioner engaged in sponsor work, within the 5 hours of CPT, it should include at least 2.5 hours of CPT related to sponsors, such as understanding regulatory rules and their updates. If you are a TC advisor or TCRO, the 5 hours of CPT should include at least 2.5 hours of CPT that must be related to the codes. What codes? Those are the Takeovers Code and Share Buybacks Code that we talked about before. In addition, individual practitioners need to complete at least 2 hours of CPT on ethics or compliance topics. The 5 hours of CPT directly related to regulated activities and the 2 hours of CPT on topics relating to ethics or compliance can both be counted within the 10 or 12 hours required for licensed representatives or responsible personnel. Finally, for new individual practitioners, there is a one-off requirement, which is to complete 2 hours of CPT related to ethics within 12 months. What type of training do we need to participate in to meet the CPT, continuing professional training requirements? First, you can be a teacher, that is, teaching others, including giving speeches and publishing papers. You might find this strange. CPT is about learning new things, so why does teaching others count as CPT? Before engaging in the activities mentioned earlier, you may need to do some industry research or prepare lessons on your own. This is also considered learning new knowledge, and the SFC, Securities and Futures Commission, counts them as CPT. Second, you can be a student, which is learning from others, including attending courses, workshops, seminars, and so on. As we now have distance learning, if you participate in approved distance learning courses that require you to submit assignments, this can also be counted. Remember, reading newspapers and financial magazines, activities that do not require interaction with others, do not count as CPT. Let me ask you, does reading the news count as CPT? No, it doesn't. Does reading financial magazines count as CPT? It doesn't either. Licensed individuals need to undergo CPT, continuing professional training every year, hoping that you all can be Iron Man. What does the training content include to become an Iron Man? If you are a general licensee, you need to understand industry regulations, such as applicable compliance, legislative and regulatory standards, or business conduct and ethical standards. The SFC, Securities and Futures Commission's guidelines are frequently updated, so licensees can ensure their own and their company's activities are compliant through CPT. In addition, licensees need to enhance their personal skills, such as basic accounting theory, fintech, and cybersecurity. For industry knowledge, including market developments, new financial products, and risk management systems, these all help licensed personnel to grasp industry trends. If you are a responsible officer, you need to undertake additional training on other topics, including business management, risk management and control strategies, financial reporting and quantitative analysis, etc. These topics help responsible officers to effectively carry out corporate governance and supervision. If you fail to comply with the requirements of the guidelines on CPT, such as not undergoing training or not keeping appropriate records, it will cast doubt as to the fitness and properness. What will happen then? If you are a responsible officer or licensed representative of a licensed corporation, the SFC, Securities and Futures Commission, may initiate disciplinary proceedings against you. If you are an executive officer or relevant person of a registered institution, the HKMA, Hong Kong Monetary Authority, will initiate disciplinary proceedings against you. The HKMA, Hong Kong Monetary Authority, also has requirements for personnel engaged in regulated activities. In a registered institution, personnel responsible for or engaged in regulated activities need to comply with the guidelines of the SFC, Securities and Futures Commission, including fit and proper guidelines, guidelines on competence, and guidelines on CPT. Do you remember who conducts regulated activities in a registered institution? The answer is relevant individuals and executive officers. For registered institutions, relevant individuals are equivalent to licensed representatives and need a registration number, which can be found in a register maintained by the HKMA. As for executive officers, they are equivalent to responsible officers. Remember these names and don't get confused. You can look at the diagram on the right. For each type of regulated activity conducted by a registered institution, at least 2 executive officers must be appointed, and at least 1 executive officer must be able to supervise the business at all times. The Securities and Futures, Licensing and Registration, Information, Rules is subsidiary legislation, mainly concerning the information requirements related to the licensing and registration of securities and futures. It specifies several things, including: firstly, the information provided in applications submitted to the SFC, Securities and Futures Commission, including what forms should be filled out and what information should be provided when different types of applicants apply to the SFC. For example, if a company needs to apply for a license, in addition to filling out an application form, it also needs to submit additional documents such as financial statements. Secondly, notification of changes. Intermediaries, licensed representatives, and substantial shareholders need to notify the SFC in writing when their information changes. For example, if there are changes for the executive officers of intermediaries or changes in the equity structure. Thirdly, licensed persons need to submit annual returns to the SFC. When should they be submitted? Within 1 month of the anniversary date of licensing or such other date as the SFC may approve. Fourthly, particulars for entry in the public register maintained by the SFC. Licensed representatives or registered institutions need to register some information in the register, such as the effective date of the license, the effective date of conducting regulated activities, whether the license has been temporarily suspended, etc., and they also need to update it at the appropriate time. This table summarizes several important subsidiary legislations under the Securities and Futures Ordinance. Do you remember who established these subsidiary legislations? It is the SFC. After the SFC establishes these subsidiary legislations, do the licensed corporations under its jurisdiction, i.e., the licensed corporations regulated by the SFC, have to comply with them? Of course, they must comply, but don't forget that registered institutions also need to comply with some of the subsidiary legislations established by the SFC. So, I want to ask, are these financial resources rules, client securities rules, client money rules, keeping of records rules, contract notes, statements of account and receipts rules, and accounts and audit rules considered laws? These rules, remember that they are all subsidiary legislations. If you violate these subsidiary legislations, it is equivalent to breaking the law, and there is a chance of imprisonment, right? It's not guaranteed imprisonment, but there is a possibility. Here's another tip for you: look at this table and anything related to money, including what? Financial resources rules, client money rules, and accounting and auditing rules. These rules involving money, registered institutions do not need to comply. Why? Because registered institutions, in other words, banks, have to listen to whom? That would be the HKMA, Hong Kong Monetary Authority, so they must comply with the relevant regulations and guidelines of the HKMA. Capital requirements are an important part, and we also have a subsidiary legislation called the FRR, Securities and Futures, Financial Resources, Rules. Note the first point in the red text: registered institutions do not need to comply with this legislation. Why? Because the HKMA, Hong Kong Monetary Authority, also has capital requirements. Therefore, this legislation only applies to licensed corporations. One of the primary criteria for the SFC, Securities and Futures Commission, to judge whether a licensed corporation is an appropriate candidate is to consider its financial situation. It's much like many people choosing a husband. It doesn't matter if he's not handsome, the key is to marry a rich man. So why should there be capital requirements? The saying goes, "He that cannot pay, let him pray." Licensed corporations need to have sufficient capital in order to support the level of its business activities, that is to say, to enable them to continue operating their existing business. When facing liabilities, licensed corporations still have the ability to repay their debts. Even if there are sudden changes, disturbances, or crises of confidence in the market, they can still provide a buffer and have funds to cope with the crisis. Having sufficient capital and licensed corporations can also help stabilize the market. Therefore, for regulatory authorities, implementing capital requirements is a way to ensure that licensed corporations have sufficient capital. Remember, licensed corporations need to submit financial reports to the SFC, Securities and Futures Commission, including a balance sheet. What is a balance sheet? It provides the information used to check the financial health of a licensed corporation at a certain point of time, such as how much assets the company holds, what liabilities it needs to pay, and shareholder equity, etc. Through the balance sheet, the SFC can check its financial health. So, what are the FRR, Securities and Futures, Financial Resources, Rules requirements for the balance sheet? It needs to compile the data of the balance sheet using certain specific criteria, including, using a generally accepted accounting principles, must recognize the substance of transactions, must be calculated on trade dates, and listing all liabilities. Note that unless the SFC agrees, all liabilities shown on the balance sheet need to be included. The FRR have several important provisions. First, liquid capital. Second, paid-up share capital requirements. Third, miscellaneous requirements. These three provisions are related to the balance sheet, and we will explain them one by one, okay? Before understanding the FRR, Securities and Futures, Financial Resources, Rules on Liquid Capital, there are a few concepts you need to know. The first concept is liquid assets. So what is it? Simply put, they are assets that can be quickly realized. The FRR required licensed corporations to have sufficient liquid assets for debt repayment. The SFC, Securities and Futures Commission, considers the liquid value of assets based on the speed of asset liquidation. The faster the asset is liquidated, the higher its value. Conversely, the slower the asset is liquidated, the lower its value. Therefore, calculating the value of liquid assets is equivalent to calculating how much money all the assets you currently have can be liquidated in an emergency. We have made a simple formula to help everyone understand. The liquidity value of a certain asset equals 1 minus the haircut percentages multiplied by the asset value. Cash, bank deposits, these can be used at any time, no need to make any haircut percentages, so the deduction rate is 0. Therefore, its liquid value is 100% equal to the asset value, while for fixed assets, such as real estate, it takes a longer time to liquidate, so the haircut percentages is 100% and its liquid value is 0. Intangible assets, such as patents or goodwill, are hard to liquidate, so the deduction rate is also 100%. So, are stocks liquid assets? In theory, yes, because stocks can be sold immediately or in a short time. However, you may incur losses in the process of selling, so you need to make deductions. As for how much to discount, what is the deduction rate, it depends on the category of your stocks. For example, if a company currently has 1 million in stock and the regulatory authority stipulates a deduction rate of 20%. Therefore, the liquid value of the stock assets equals 1 minus 0.2 multiplied by the pre-liquidation value of the stocks, which is 1 million, so the liquid value is 800,000. Liquid capital, in addition to considering liquid assets, also needs to calculate the ranking liabilities. What are ranking liabilities? They are the liabilities included in the calculation that are the total liabilities of the licensee. These liabilities may be various amounts owed by the licensee, such as loans, accounts payable, etc. How are liabilities taken into account? The SFC, Securities and Futures Commission, is most concerned about whether you have enough money, so basically, it requires you to calculate all liabilities. There are only some special situations where the SFC agrees not to include them in the total liabilities, and there is a chance that they are not calculated, but this situation is very rare. For example, loans which the lenders have agreed to subordinate to the rights of other creditors and lenders. So, what is liquid capital? Liquid assets minus ranking liabilities is liquid capital that can be used by a licensed corporation to repay debts in emergencies. The SFC, Securities and Futures Commission, will set predefined levels of liquid capital for various types of regulated activities, and may also adjust these levels based on the situation of the licensed corporation. For example, if the licensed corporation does not hold client assets, it is less likely to have problems, and the SFC allows them to have lower liquid capital requirements. Regardless of the situation, liquid capital must always be maintained at no less than the required capital level. Apart from liquid capital, licensed corporations also need to comply with the paid-up capital requirements. So, what is paid-up share capital? It's the money you and other shareholders put in to start a business. Simply put, it's the capital required when initially establishing the licensed corporation. So, what requirements has the SFC, Securities and Futures Commission, set for paid-up capital? When a licensed corporation conducts regulated activities, it needs to maintain a certain level of paid-up share capital at all times. Different regulated activities have different paid-up capital requirements, with the highest reaching 30 million. For example, leveraged foreign exchange trading, such as securities margin financing, which involve borrowing or holding client assets, are required to have higher paid-up share capital. If I engage in more than one type of regulated activity, for example, I do the Type 1, Type 4, and Type 9 regulated activities at the same time, how do I calculate? You look at which regulated activity requires the highest paid-up capital, and we use the highest one as the standard. Do all licensed corporations have to comply with the paid-up capital rules? Licensed corporations that do not hold client assets do not need to comply, such as approved introducing agents, securities advisors, corporate finance advisors, asset managers, credit rating agencies without holding client assets. The FRR, Securities and Futures, Financial Resources, rules required licensed corporations to have sufficient liquid capital and paid-up share capital, but what should you do if you cannot meet these requirements? Several situations may arise. First, if you find that you can no longer maintain the specified liquid capital and paid-up share capital, what should you do? Immediately cease all your regulated activities and promptly notify the SFC, Securities and Futures Commission in writing. Second, if your liquid capital is below 120% of the required liquid capital, or 50% less than the last liquid capital reported, you also need to notify the SFC in writing within 1 business day. Remember, the 2 situations mentioned above are often asked in the exam, so you must remember them. In addition to these, other serious situations, such as changes in information leading to errors in your previous reports, or borrowing money but being unable to repay, these are not immediate problems. You can notify the SFC within 1 business day. How does the SFC, Securities and Futures Commission, know how much liquid capital you have? If you are a licensed corporation holding client assets, you need to submit a report and relevant supporting documents to the SFC every month. In the report, you should explain how the liquid capital is calculated, the current financial situation, the status of bank loans, analysis of client assets, etc. When should this monthly report be submitted? It should be submitted to the SFC within 3 weeks after the end of each month. In addition, licensed corporations holding client assets must also submit quarterly reports and relevant supporting documents to the SFC, including analysis of its clientele, analysis of its proprietary derivative positions, etc. When should these be submitted? They should be submitted every 3 months, that is, in March, June, September, and December. These should be submitted to the SFC no later than 3 weeks after the end of each quarter. The above are for licensed corporations holding client assets. If I am a licensed corporation that does not hold client assets, when should I submit a report to the SFC? In that case, you need to submit a report to the SFC every 6 months. Similarly, you should provide the SFC with liquid capital computation, analysis of its profit and loss account, analysis of its clientele, etc. In short, if you are a licensed corporation holding client assets, you need to report more frequently, submitting reports every month and every 3 months. However, if you do not hold client assets, you do not need to report as frequently, and a report every 6 months will suffice. If the SFC, Securities and Futures Commission, needs to review the licensed corporation's compliance with the FRR, Securities and Futures, Financial Resources, rules, it can at any time, by notice in writing, request a licensed corporation to provide information relating to the financial resources or trading activities of the licensed corporation, including any records and documents. The licensed corporation must comply with the SFC's request, submitting the information to the SFC within the specified time frame and manner as outlined in the written notice. In terms of financial resources, the SFC, Securities and Futures Commission, can conduct a series of reviews and approvals for the applications submitted by licensed corporations, including the SFC can approve individual licensed corporations to become approved introducing agents. The requirements for liquid capital and paid-up capital for approved agents can be lower. For instance, for those engaged in Type 3 regulated activities leveraged foreign exchange trading, the usual requirement for liquid capital is $15 million, and the paid-up share capital is $30 million, whereas an approved agent only needs $3 million for liquid capital and $5 million for paid-up share capital. So, which licensed corporations can apply to become approved introducing agents? Licensed corporations that only introduce specific types of businesses do not hold client assets and can incur no legal liabilities that can apply to become approved introducing agents. For example, the main business of a securities introducing broker is to introduce, at the request of their clients, different securities brokers. After the client has chosen a specific securities broker, they convey the client's buying and selling instructions in the client's name to the specific securities broker, which completes the transaction. They do not participate in any transactions themselves, do not receive or dispose of the client's assets, so can incur no legal liabilities for the client's related transactions. The role is similar to that of a professional referral agency. They introduce people. Whether you hire or not is up to you to negotiate. Once the employment agreement is signed, it has nothing to do with me. Does that mean no legal responsibility at all? No, what's meant here is not to assume any legal responsibility to anyone for the client's related transactions. If you're negligent, deliberately default, or engage in fraud due to your own actions, you are still legally responsible. The SFC can also approve redeemable shares to become approved redeemable shares, and approve subordinated loans to become approved subordinated loans. What are redeemable shares? It means that, after the shares are issued, the company can redeem and cancel them. As for what is a subordinated loan? It refers to loans that need to be repaid under certain conditions, such as when the company makes a profit. These two items are usually considered as ranking liabilities and are included in total liabilities. After the SFC's approval, they can be excluded from liabilities or deducted from total liabilities. As we've introduced before, licensed corporations need to regularly report their financial position, including preparing balance sheets and liquid capital computation using generally accepted accounting principles. With the SFC's approval, under specific circumstances, licensed corporations can prepare balance sheets using accounting principles other than generally accepted ones, and amend or waive the calculation of liquid capital. Not only that, without compromising the interests of any client or the public, the SFC can also approve the amendments or exemptions to the financial resources rules. In short, the SFC has extensive review and approval powers over financial resources in respect of licensed corporations. What role do intermediaries in the securities and futures industry play in handling clients' assets? They handle them in a fiduciary capacity. What is fiduciary capacity? It means an individual or institution that is entrusted to manage and handle the assets of others. To protect investors' assets, the SFC, Securities and Futures Commission, has established rules for holding and handling client assets, securities collateral, and client money. In the following sections, we will discuss how the SFC regulates intermediaries in handling client securities and money. Let's ask everyone, in Hong Kong, who can receive or hold client assets of intermediaries. First of all, it's the intermediary themselves, as they need to act in a fiduciary capacity to handle clients' assets. Naturally, they can receive or hold client assets. Second, associated entities of the intermediary. Do you remember what we said about associated entities? An associated entity refers to a company that not only has a controlling entity relationship with the intermediary, meaning the company has control over the intermediary, but also needs to receive or hold the client's assets of the intermediary in Hong Kong. Therefore, associated entities can naturally receive or hold client assets as well. Third, excluded persons. What types of persons can be excluded? This includes AFI, authorized financial institutions, such as banks, another intermediary with whom client securities collateral is deposited under financial accommodation arrangements, any company or non-Hong Kong company approved by the SFC, Securities and Futures Commission, any person specified under rules made by the SFC with whom designated trust accounts or client accounts are to be maintained. The Securities and Futures, Client Securities, Rules is a subsidiary legislation under the SFO Securities and Futures Ordinance, aimed at protecting client assets, client securities, and securities collateral. It mainly consists of several provisions. The first provision is about how to safeguard client assets and securities collateral. Intermediaries and associated entities must adopt appropriate measures to safeguard client assets and securities collateral. They can be stored and registered in segregated accounts. The second provision specifies the conditions under which intermediaries or associated entities can handle client assets or collateral, which helps prevent intermediaries from abusing client assets and regulates their behavior. Now you have a preliminary impression, and we will further explain the securities and futures, client securities, rules in more detail later. All intermediaries need to comply with the securities and futures, client securities, rules, which means registered institutions and licensed corporations must comply. So, to which client securities or securities collateral assets do the client securities rules apply? There are two main conditions. First, it applies to securities listed in Hong Kong. That is, securities listed or traded on the SEC, the Stock Exchange of Hong Kong Limited, or interests in CIS, collective investment schemes recognized by the SFC, Securities and Futures Commission, are subject to the client securities rules. Second, the securities held or received in Hong Kong by the client through an intermediary or their associated entities are also regulated by the client securities rules. In other words, if the client opens an account in their own name and holds the securities themselves, rather than through an intermediary or their associated entities, they would not be subject to the client securities rules. So, I want to ask you, suppose I buy Japanese stocks in Hong Kong through a brokerage firm, are these Japanese stocks affected by the client securities rules? No, they are not affected because these Japanese stocks are not listed in Hong Kong. The client securities rules only regulate securities listed in Hong Kong or CIS recognized by the SFC, and the securities must be held on behalf of the intermediaries or associated entities in Hong Kong. Let's take another example. If I receive an IPO allocation and have an account with Sun Hung Kai Securities. After receiving the allocation, as long as I don't deposit that IPO stock into my Sun Hung Kai Securities account, it's not considered client securities. In other words, if I deposit this IPO stock into my Sun Hung Kai Securities account, it will then become client securities. Pay attention, we need to discuss a frequently misunderstood topic by students: standing authority. What does standing authority mean? Standing authority is a long-term authorization for the intermediary or associated entity to handle the client's assets and securities as a routine, for the intermediary or associated entity to handle the client's assets and securities. To avoid disputes, standing authority is established in writing, clearly stating instructions for handling assets and how to revoke the authorization. After receiving the written instruction, the intermediary will process the client's assets in accordance with the methods in the standing authority. Generally speaking, the validity period of the standing authority will not exceed 12 months. After you sign it, the intermediary will process client assets according to the methods in the standing authority. Unless you are a professional investor not restricted by the SFC, Securities and Futures Commission, the validity period generally will not exceed 12 months. If you want to revoke it, the method of canceling this standing authority will also be clearly stated. This means that when you open an account at a brokerage firm to trade stocks, you need to fill out a form authorizing the intermediary to operate according to the standing authority. For example, if it needs to settle, then transfer some money from my HSBC bank account for settlement. After settlement, then deposit it into my securities account. The standing authority clearly describes this series of operations, such as how to deposit money, how to withdraw money, how to deposit stocks, how to withdraw stocks, and how to cancel this standing authority. After we have written down what to do, it becomes a routine for the intermediary to operate according to these instructions. How is the standing authority renewed? The standing authority can be renewed at any time before its expiration. As a client, you can request an early renewal in writing. Do you remember the maximum validity period? It's up to 12 months. If you are a professional investor, there is no limit to the renewal period. What if the client does not actively renew the standing authority? In that case, the intermediary or associated entity should send a letter to the client 14 days before the expiration date. What should be written in the letter? First, it should remind the client that the expiration is approaching. Second, unless the client objects, if the client does not reply, the standing authority will be automatically renewed for another 12 months under the same terms. Within a week after the automatic renewal, the intermediary or associated entity has to provide a written confirmation of the renewal to the client. How should an intermediary handle securities received from clients, such as stocks, bonds, etc.? First of all, it needs to be clear whether the securities received by the intermediary are client securities or securities collateral. Client securities are the securities that the client entrusts to the intermediary for safekeeping and does not owe the intermediary money. Securities collateral are securities that the client has taken to the intermediary to borrow money, so these securities have not yet repaid the intermediary's debt. The nature of the two is different, so they must be stored separately. Remember, client securities and securities collateral must be stored separately, they must be separated. Secondly, find a place to store them as soon as possible. Remember, the intermediary must not store them in their own company, there must be a third party. The choices could be an AFI, authorized financial institution, such as a bank, an approved custodian, that is, custodians recognized by the SFC, Securities and Futures Commission, specifically used to store client securities or securities collateral, another intermediary licensed for dealing in securities. The intermediary or its associated entity can choose any of the above three places to store client securities or securities collateral. So remember, never store them in your own company, you must find a third party to store them. So, how should they be stored? Let's talk about client securities first. Remember, the client securities do not owe the intermediary money. The intermediary must put the client securities in a segregated account opened by the intermediary, designated as trust accounts or client accounts. The segregated account is a specialized account, such as ABC Securities All Clients. Its purpose is to separate from the intermediary's own company account and specifically manage the client securities. For example, when ABC Securities receives securities from the client, Chan Tai Man, they can specifically manage Chan securities in the ABC Securities All Clients or ABC All Clients Chan Tai Man. Securities account opened by ABC Securities at HSBC Bank and should not place them in the account of ABC Securities Company. Remember, you should never put them in an account opened by an intermediary in their own name. So, under whose name are the client securities received by the intermediary registered, or in other words, held? If the client has special instructions, the intermediary can store the client securities received on behalf of that client in the client's personal account. For example, Chan Tai Man bought some stocks through ABC Securities and asked ABC Securities to store the stocks in his personal investor's stock account. Chan Tai Man. In the central clearing and settlement system. If there are no special instructions, the client securities will be registered in the name of an associated entity of the intermediary and held by the intermediary's associated entity. Do you still remember what an associated entity is? It is a company which is in a controlling entity relationship with the intermediary and receives or holds in Hong Kong client assets of the intermediary. Therefore, naturally, an associated entity can receive or hold client assets. So how should securities collateral be stored? The method for securities collateral is similar to that for client securities. They can be placed in a segregated account opened by the intermediary at a third-party institution, such as ABC Collateral Securities All Clients. The difference is, securities collateral can also be stored in an account opened and in the name of the intermediary or its associated entity at a third-party institution, whereas client securities absolutely cannot. Why is that? As we mentioned before, securities collateral are pledged by the client to the intermediary, meaning that the client's loan has not yet been repaid, and the client still owes the intermediary money. So in this situation, securities collateral can be stored in an account opened in the name of the intermediary or its associated entity. When the client cannot repay the money, the intermediary can sell these collateral items to repay the debt. Therefore, when registering, securities collateral can not only be registered in the client's name, but also in the name of an associated entity of the intermediary, and even in the name of the intermediary. We have made a table to help everyone distinguish between the treatment and registration of client securities and securities collateral. The main differences between the two are, in terms of storage, client securities can only be placed in the intermediary's segregated accounts, while securities collateral can also be placed in the account of an intermediary or its associated entity. In terms of registration, client securities cannot be registered in an intermediary's name, while securities collateral can be. Intermediaries or associated entities can only handle client securities or securities collateral according to the client's authorization. What are the various ways of granting such authorization? Clients may provide oral or written directions to sell or settle a sale order. Intermediaries can also act according to other written instructions or standing authorities from the client. Do you remember what a standing authority is? It refers to a long-term authorization for the intermediary or associated entity to handle the client's assets and securities as a routine, such as withdrawing or depositing securities from a specific account, and so on. If the client and the intermediary have entered into a written agreement, the intermediary can also perform two main operations. First, on behalf of the client in selling client securities, or to settle a sale order. Second, when the client owes debt and has also signed a written agreement to agree, the intermediary can also sell client securities and securities collateral to repay the debt. So, what kind of transactions does a standing authority usually allow the intermediary to perform? First, it allows the intermediary to provide financial accommodation to clients, in other words, to lend money to clients. For example, a client, Chan Tai Man, has some securities in his possession and wants to borrow money from the securities company. Chan Tai Man can then use the securities he holds as collateral to borrow money. Once the intermediary has provided financial accommodation to the client, the intermediary can also use client securities or securities collateral for stock borrowing and lending transactions, or repledge the securities collateral with an AFI to borrow money. What does this mean? This means that a client uses securities as collateral to borrow money from a securities company, and the securities company then repledges these securities as collateral to borrow money from a bank. However, this operation is limited, meaning the aggregate value cannot exceed 140% of the intermediary's aggregate margin loans on the same business day. If it exceeds this, the intermediary must, by the close of the next business day, reduce the aggregate value of repledged securities collateral so that it does not exceed 140% of aggregate margin loans. Why is this done? Mainly to prevent intermediaries from overusing debt for investment. If the intermediary cannot repay the loan, it may trigger a chain effect in the market, so this operation must be restricted to reduce the risk to the market. In addition, the intermediary can deposit securities collateral into the clearing house, or deposit it into another intermediary involved in dealing in securities, as collateral for debt repayment, to repay the client's debt. What are some things that an intermediary or associated entity cannot do with standing authorization? As we've mentioned before, if it's client securities, which are the securities paid for by the client, they cannot be held by the intermediary or associated entities. Speaking of this, would it be okay if I find an employee and put them in their account? The answer is no. Client securities cannot be transferred to the accounts of an intermediary's employees unless the employee is the client. The Securities and Futures, Client Securities, rules also stipulate that client securities and securities collateral cannot be handled in any manner that is unconscionable, so don't think about playing tricks. The most important points to remember about the client securities rules are: first, be clear about when to use the client securities rules. It applies to securities listed in Hong Kong and are held on behalf of clients by Hong Kong intermediaries. Second, securities and securities collateral must be stored separately. Master these two key points, and you'll be a master of the client securities rules. The securities and futures, client securities, rules also include some miscellaneous provisions, which include: first, the SFC, Securities and Futures Commission, has the right to approve any company or non-Hong Kong company to become an approved custodian, which means that the SFC has assessed these companies as suitable to properly safeguard the client securities and securities collateral of intermediaries. After being granted approved custodian status, these companies can provide intermediaries with client securities and securities collateral custodian services. Second, if you discover that you are unable to comply with the client securities rules, you have a responsibility to report to the SFC within 1 business day. Let's briefly introduce the securities and futures, client money, rules. Seeing the words money, you know it's related to finance. The client money rules stipulate how licensed corporations and their associated entities handle client money received or held in Hong Kong. That is, how to manage the funds of clients. These rules also specify the procedures for depositing client money into a segregated account, how to deal with earned interest, and how to report situations where the rules have not been complied with. By now, everyone should have a preliminary understanding of the client money rules. Get ready, we will talk about what the provisions in the client money rules are like next. As soon as you see the client money rules, you know it has to do with money. The client money rules regulate how licensed corporations and their associated entities handle client money received or held in Hong Kong, that is, how they handle client money. This rule explicitly stipulates client money received must be deposited into a segregated account, how to withdraw funds, how to handle the earned interest, and how to report situations of non-compliance with the rules. Next, we will talk about some of the provisions of the client money rules in detail. First, the scope of application of the client money rules. What is client money? All the money held by the licensed corporation or associated entity for the client during the conduct of regulated activities are called client money. Simply put, it is the money that the client entrusts to the licensed corporation for safekeeping. This money should also be deducted from all the debts and fees that the client owes to the licensed corporation. For example, a client owes the licensed corporation $5 million, but he writes a check of $10 million to the licensed corporation. So what money is called client money? It is the $10 million minus the debt of $5 million, so the remaining $5 million is called client money. Client money must be received or held in Hong Kong, and the money must still remain in Hong Kong. If the licensed corporation receives the client's money, no matter whether the money comes from Hong Kong or overseas, as long as it is currently not in Hong Kong, it is not client money protected by the client money rules. In addition, the client money rules also require that the funds cannot be held in the name of the client himself. If a client goes to the bank to open an account in his own name, and the securities firm is authorized to withdraw money from this account to buy and sell securities, is this considered client money? It's not considered client money, because the account is held in the client's own name and is not protected by the client money rules. Up to this point, we have always emphasized the client money of the licensed corporation, but we have never mentioned the registered institutions. Why is this? Note: the client money rules only apply to licensed corporations and their associated entities. Do registered institutions need to comply with the client money rules? No, because the HKMA, Hong Kong Monetary Authority, has relevant requirements. All money-related matters of registered institutions follow the guidelines of the HKMA. Let's summarize the 5 key points of client money. First, the money held by the licensed corporation or associated entity for the client. Second, after deducting all the client's debts and fees to the licensed corporation. Third, the money are received or held in Hong Kong. Fourth, the funds are still in Hong Kong. Fifth, the funds are not held in the name of the client himself. If these conditions are met, we can call it client money, and it can be protected by the client money rules. What should a licensed corporation or associated entity do upon receiving a client's money? Within 1 business day, you should process it in the following ways. First, deposit the money into a segregated account. As the client's money comes from the client, in order to avoid confusion with the company's own money, it must be placed in a third-party independent institution. If it's not deposited into a segregated account, then payment should be made. How should this be done? You can return this money directly to the client, or if it is collected on behalf of the client, you can give the money back to them. If there is a written instruction from the client, you can pay the amount according to the written instruction. If there are no written instructions, you can still handle it according to the client's standing authority, that is, the long-term authorization set by the client in advance. In short, after a licensed corporation receives client money, it must deposit or pay it within 1 business day following the methods mentioned above. If the money isn't paid out within 1 business day and is instead deposited in a segregated account, how should a licensed corporation or associated entity handle this money subsequently? The money stored in a segregated account does not have a processing time limit and can stay there until you return this money to the client, or handle it according to the client's written instructions or standing authority. In addition, you can use this money to pay for the client's regular securities, futures transactions, or margin expenses. If the client owes money to the licensed corporation, you can also use it to repay the debt. What should a licensed corporation or associated entity do upon receiving a client's money? You should process it within 1 business day in 4 ways. As mentioned before, after a licensed corporation or associated entity receives client money, it should be processed within 1 business day, either by payment or by storage. When storing, it must be placed independently with a third-party institution. What are these third-party institutions? There are 2 types of third-party institutions here: AFI, authorized financial institutions, such as banks or other persons approved by the SFC Subsidiaries and Futures Commission. In any case, client money cannot be placed with a licensed corporation or associated entity of a licensed corporation. It must be stored in a third-party institution. Like securities, the accounts opened in third-party institutions must be segregated trust accounts or client accounts. Be sure not to use accounts established under the name of the licensed corporation or associated entity, because the company's own money and the client's money must be stored separately. If the money is placed in a third-party institution, such as a bank, you may receive some deposit interest. If we keep money on behalf of a client, can we put this interest into our own pocket, thinking that getting rich easily is not a dream? Remember, never do this. Don't put the interest into your own pocket. The interest generated by the client's funds belongs to the client. Of course, unless there is a written agreement with the client agreeing that you can take the interest, otherwise, it must be returned to the client. The securities and futures, client money, rules also have some measures to protect clients' money. When receiving a client's money, a licensed corporation or an associated entity cannot deposit the money into its own account or into some employee's account in the company. In short, all unfair, inappropriate, and unreasonable ways of handling clients' money are not allowed. If there is a sum of money in the client's separate account that does not belong to the client, can I pocket it? No, you can't. Within 1 business day after discovery, the licensed corporation or associated entity is required to pay any money held in a segregated account that is not client money out of the account. If the intermediary misuses the client's money without permission, it is an offense and can be sentenced to prison, all right? I'll repeat because it's important. A licensed corporation or an associated entity must open a segregated account to safeguard clients' money. After receiving clients' money, it must be deposited into the segregated account and kept there. You cannot use the client's money without reasonable excuse. If you find out that the company has made a mistake and not followed the rules, what should you do? You should report it to the SFC Subsidiaries and Futures Commission within 1 business day. If you have no reasonable excuse, or with an intention to defraud, is an offense and the offender is liable to pay penalties and to imprisonment on conviction. The securities and futures, keeping of records, rules, which are about how you keep accounting, transaction, and other records. All intermediaries and associated entities must follow this, including licensed corporations and registered institutions. So why do we need to keep these records? What's the purpose? These records can explain and reflect the financial position and operations of the regulated business, showing how the client assets are handled and the changes in these assets. Moreover, it facilitates intermediaries to prepare the company's financial statements and conduct auditing work at any time. If something happens, intermediaries can present these records to external parties for verification, such as regulatory agencies. The most important thing is that intermediaries can use these records to prove that you have complied with the rules, such as the Financial Resources Rules, and can also reflect that intermediaries have systems of control. What should be the form of records? No matter what kind of record it is, it should be in Chinese or English, in writing or in any other form that may be readily accessed and convertible into writing. Also, there should be reasonable procedures to prevent and detect any records from being tampered with. If you want to set a time limit for the retention of data, how long would you think? Well, it's not up to what you think. The law clearly states how long these records should be kept. General records should be kept for at least 7 years, for example, monthly statements of account. Records of over-the-counter derivatives should be kept for at least 5 years. Orders and instructions, for instance, a client orders you to buy HSBC at $80, you should keep the record, and it needs to be kept for at least 2 years. Contract notes, daily statements of account and receipts also need to be kept for at least 2 years. As for telephone recordings, they should be kept for at least 6 months. If you do not comply with the provisions of the Keeping of Records rules, it's also illegal. If you have no reasonable defense or intent to defraud, you may be fined or even imprisoned. The Keeping of Records rules specify the duration for retaining data, but it turns out there are also regulations about when to give the bill to the client. The contract note rules list the deadlines for intermediaries and associated entities to issue documents to the client. Contract notes, daily statements of account, and receipts need to be issued within 2 business days after the specified event occurs. For monthly statements, you need to be careful. If you are a regular licensee, you need to send the monthly statement to the client within 7 business days after the end of the monthly accounting period. If you are an asset manager, you need to send the monthly statement to the client within 10 business days after the end of each monthly accounting period. The Contract Notes Rules is also a subsidiary legislation, which mainly stipulates that intermediaries and associated entities need to provide various documents to clients. What kind of documents? Evidence of transaction data, such as account monthly statements, transaction documents, receipts, etc. This rule stipulates when you should provide these to clients, what information the documents should contain, etc. It's like when you go to 7-Eleven to buy a soda, they will give you a receipt, which has the purchase time, what you bought, and how much it cost written on it. Remember, all intermediaries and their associated entities must comply. However, the Contract Notes rules may not apply to PIs, professional investors, provided that the professional investor confirms in writing that they do not wish to receive such documents or monthly statements. For these PIs, as an intermediary, you do not need to comply with the Contract Notes rules. What exactly are contract notes? In the securities and futures market, a contract note is a document that confirms the completion of a transaction and records the details of the transaction. What kinds of transactions require contract notes? Remember, dealings in securities, dealings in futures contracts, leveraged foreign exchange tradings all require contract notes. When a client instructs you to place an order, you execute the transaction for the client. Then, you have to issue a contract note to the client for the transaction you've made. When should a contract note be issued? You must issue a contract note to the client within 2 business days after the transaction date, informing the client that the transaction has been completed. If there is more than one transaction for the same client within the same day, we can include several contracts in the same contract note or can be consolidated into the daily statement. That is, once you've sent the daily statement to the client, there is no need to send a contract note again. What information should be included in a contract note? They should include the client's name, account number, the name under which the intermediary carries on business, full particulars of the contract, and the identity used by the intermediary. Unless it is a LFE, leveraged foreign exchange contract, you must clearly let the client know who they are trading with now. In addition, the transaction documents should also indicate whether the account is a margin account. What is a margin account? Margin accounts are mostly used in leveraged trading, where investors may provide a small portion of funds as margin to borrow money to conduct larger-scale trades, so the risk is relatively high. A statement of account, like a bank statement, can be daily or monthly. Let's first discuss the daily statements of account. What are daily statements of account? It's a record of all transactions and balance situations within a day. Who prepares this daily statement, and under what circumstances is it issued? Firstly, it's prepared by intermediaries or their associated entities that provide securities margin finance. What is securities margin finance? It's when the intermediary lends you money to buy securities. How does it work? Investors open a margin account and don't have to pay the full amount, only a portion of the money, to buy securities with a higher present value. For example, using $10,000 to buy securities worth $20,000, and the remaining $10,000 is covered by the intermediary. When you borrow, there has to be collateral, so the $20,000 worth of securities in your margin account becomes the collateral. When a specified event occurs, such as when a client deposits or withdraws assets, the intermediaries that provide securities margin finance or their associated entities need to prepare daily statements of account. Secondly, it's prepared by intermediaries that conduct margin transactions with or on behalf of a client. When a margin transaction takes place, or when a margin transaction is closed, they need to provide a daily statement to the client. What does it mean to close a margin transaction? It means that the position becomes zero. Suppose you bought a quantity of merchandise and then sold all of it. This is called closing the position. In margin trading, the net asset value in your account must be higher than the required margin. If it's not enough, you need to deposit more money. This is called margin call. It's like if your octopus card runs out of money and goes negative, you need to top it up. If you really can't afford the margin call, your creditor, the intermediary, may help you close the position, selling all your securities collateral. When should the intermediary issue the daily statements of account? Within 2 business days after the aforementioned events occur, the intermediary or their associated entity needs to issue the daily statements of account to the client. If more than one transaction occurs with the same client on the same day, the daily statement can replace the contract notes. What information needs to be included in a daily statement? Similar to a contract note, a daily statement needs to provide basic information, including information on the client and the intermediary, date of the statement preparation. For statements relating to securities margin finance, the following information needs to be provided: the opening and closing balances of the account and all movements in balance during the day. This allows the customer to know whether the amount has increased or decreased and the amount of the changes. In addition to the balance, in the case of margin accounts, there will be different securities and collateral inside the account. Therefore, it is necessary to display all the changes that occurred on that day and provide the margin ratio and margin value of various securities and collateral at the end of the day. What is the margin ratio? The margin ratio is the proportion that the investor must contribute in margin trading, i.e., how much money you need to make the trade. It is set according to the risk level of the security and is used to limit the amount of money that an investor can borrow from an intermediary to purchase securities. The lower the ratio, the less money you need to spend, and the more money you can borrow to make the trade. For example, if you put in $10,000 and buy securities valued at $20,000, the margin ratio of this security is 50%. If the margin ratio becomes 25%, the intermediary will lend you more money, and you can buy securities worth $40,000. Then what is the margin value? The margin value is the maximum amount that an investor can borrow from an intermediary to purchase securities. Still, in the above example, you contribute $10,000 to buy securities valued at $20,000, i.e., the intermediary lends you $10,000, so the margin value is $10,000. If you put in $10,000 and buy securities worth $40,000, the intermediary lends you $30,000, and the margin value is $30,000. And the daily statement will display how much these securities and collateral are worth at the end of the day in terms of margin. The opening and closing balances, margin ratio, and margin value of various securities and collateral, and all changes should be reflected in the daily statement. Securities margin finance is primarily conducted with securities firms, aiming to borrow money to buy more securities, while margin transactions is a broader concept, applicable to various types of financial transactions, such as futures trading, foreign exchange trading, etc. So, what is needed in the daily statement related to margin transactions? Similar to the daily statement of securities margin finance, the intermediary needs to provide basic account information, such as information on the client and the intermediary, date of the statement preparation, etc., as well as the account balance at the start and end of the day, and all changes in the account throughout the day, letting the client know whether the balance has increased or decreased. Inside the daily statement, it also needs to provide the quantity and market value of securities and collateral provided for each margin transaction on that day, the details of changes, and the details of all completed margin transactions. At the end of the day, it needs to calculate the profit and loss of the positions the client still holds, and the net equity of the account, that is, how much available funds the client still has. The intermediary also needs to attach a list of open positions, inform the client about the minimum margin requirements, i.e., how much margin the client account must have at a minimum, whether it's margin excess or margin shortfall on that day. Margin excess. Excess means overflowing, implying that the balance of margin is more than the actual required margin amount. Conversely, if the balance of margin is less than the actual required margin amount, it's called a shortfall. In short, what must be clarified in the daily statement? First, the balance of the account at the start and end of the day, whether it has increased or decreased, and what changes have occurred in the account that day. Second, what securities and collateral this client holds, how many, what the market price is, what the market value is, and what changes occurred that day. Third, it also needs to clearly specify how much the margin value of securities or collateral is. How much money did the intermediary lend to the client in total? Fourth, the transactions conducted that day also need to be written down. Just like we mentioned before, if there are multiple transactions that day, the daily statement can replace the contract notes, so it also needs to include open positions, i.e., the profit and loss of the positions the client still holds. You also need to specify the minimum margin requirements of the open positions, i.e., how much margin needs to be maintained, and it must be clearly written on the daily statement. So what exactly is a monthly statement of account? As the name suggests, it's a summary of a month, that is, it records the transaction details and balance of the account within a month. When should a monthly statement be sent to the customer? First, the customer has made transactions during the month. Second, at the end of the month, there is still money left in the account, or there is a debt, owing money to the broker. Third, at the end of the month, there are open positions, which means there are securities in your account that have not yet been traded. These securities will still be affected by market prices. If one of the above three conditions is met, you need to issue a monthly statement to the customer. So, if there is no activity in the account, no transactions, no debts, and no balance, do you still need to issue a monthly statement? No, you don't. When should the monthly statement be delivered to the customer? Generally, persons licensed should issue monthly statements to clients within 7 business days of the end of each monthly accounting period. If you are an asset manager, you should issue a monthly statement to the client within 10 business days of the end of each monthly accounting period. Remember, there is a special case, that is, asset managers do not need to prepare monthly statements of account for authorized CISs, collective investment schemes that it manages. All right? So, what information should be included in the monthly account statement? It includes several things. First, all contracts entered into by the intermediary for the client during the month. Second, outstanding balances of the account at the beginning and end of the month. This refers to some amounts that have not yet been dealt with, usually unconfirmed deposits, expenses that have not been deducted, or incomplete transactions. Third, all open positions held at the end of the month. What kind of receipt is referred to here? It's the receipt that the intermediary or associated entity should issue to the client after receiving the client's assets or collateral. So when does the intermediary need to issue a receipt to the client? This should be done within 2 business days after receiving the client's assets or collateral, which means 2 days after the transaction. Can the intermediary choose not to issue a receipt? Unless the client receives satisfactory confirmation through other means, in general, a receipt should be issued. I want to ask you, as a client now, do you have the right to request the intermediary to provide copies of contract notes, statements of account, and receipts to you? You absolutely have the right to request, but the intermediary can also charge you a fee for this, including administrative costs, okay? Is there any other method? Yes, you can apply to the SFC, Securities and Futures Commission, and under conditions that do not contradict the SFC's instructions, you can inspect copies of contract notes, statements of account, and receipts kept by the intermediary. If an intermediary or associated entity finds that they have not complied with the contract notes rules, what should they do? Remember, they should notify the SFC, Securities and Futures Commission, within 1 business day, and report to them first. If the intermediary or its associated entity has no reasonable excuse or attempts to defraud, it constitutes an offense. Once convicted, they can be fined or even imprisoned. The Accounts and Audit Rules is about financial matters. Therefore, registered institutions don't need to comply. Why? Because the HKMA, Hong Kong Monetary Authority, already has relevant requirements. So, who needs to comply with this subsidiary legislation? Licensed corporations and associated entities of intermediaries. Pay attention. While registered institutions don't need to comply, do their related entities need to? Yes, they do. What does the Accounts and Audit Rules dictate? Licensed corporations and associated entities of intermediaries have to prepare financial statements and other related documents every year, including a profit and loss account, a balance sheet, and notes to the accounts. Even if you are no longer engaging in regulated activities or no longer being an associated entity, you still need to prepare cessation accounts. If you are an active licensed corporation, you need to provide some additional information, including liquid capital calculations, a business and risk management questionnaire, various analyses of borrowings, and client accounts. So now you should have a rough idea of what's required. The Accounting and Audit Rules require licensed corporations and associated entities of an intermediary to submit an auditor's report each financial year. The auditor needs to confirm in the report whether the profit and loss account and the balance sheet accurately reflect the financial position, confirming that various returns of the licensed corporation are compiled accurately according to the records. If there are inaccuracies in the licensed corporation, the auditor has a responsibility to point out whether the licensed corporation has violated the SFC, Securities and Futures Commission's financial resources rules, whether the licensed corporation and associated entities have kept records in accordance with the keeping of records rules, whether they have complied with the client money rules and client securities rules, and have a monitoring system, etc. If the auditor does not want his full detailed report to be widely circulated, he can submit 2 reports, one containing normal, true, and fair report, which is relatively short and is enough to be used for wide circularization. The other can contain details of matters other than the general ones. If the auditor indeed discovers a violation or is uncertain whether it meets legal requirements, he can also submit a report or special report to the SFC. Now we begin to talk about the regulated activities under the SFO, Securities and Futures Ordinance. This table lists the 10 types of regulated activities on the SFC website, which we have introduced before, and you need to remember. Type 1 and Type 4 are related to securities. Type 1 is about dealing in securities, and Type 4 is advising on securities. Type 2 and Type 5 are related to futures. One is dealing in futures contracts, and the other one is advising on futures contracts. Type 3 is leveraged foreign exchange trading. Type 6 and Type 8 is about financing. One is to help institutions borrow money, and the other is to lend money to clients to buy securities. Type 9 is asset management. The remaining Type 7 and Type 10 mainly provide services. One provides automated services, and the other provides credit services. Do you remember these 10 types of regulated activities now? After this, we will introduce the definitions and regulations of these 10 types of activities separately. Type 1 regulated activity is dealing in securities. So, in the exam, you might be asked, what exactly are securities? Remember, securities include: first, shares, stocks. Second, debentures, notes, loan stocks. There are also warrants, which means having the right to buy a certain stock at a specific price at a specific time in the future. Collective investment schemes, the most common of which are funds, a type of collective investment scheme. Structured products, which can be considered as one of the derivatives. All of the above are securities. Derivatives of securities, such as options, interests, rights, all are considered securities. You might wonder, are all products securities? Of course not. In Hong Kong, futures and options on futures are classified as futures. There are also some unregulated products, such as London Gold, leveraged foreign exchange trading, MPF, mandatory provident fund, investment-linked insurance. These are not securities. In other words, apart from futures, options on futures, and unregulated products, we can consider everything else as securities. I want to ask you, are options considered securities? The answer is yes. Options are derivatives of securities and are therefore considered securities. Are options on futures considered securities? The answer is no, because futures and options on futures are classified as futures, not securities. What exactly is dealing in securities? Remember, dealing in securities is done for other people. If I buy stocks for myself, will I be regulated? No, and there's no need to pass any licensing test before buying stocks. To clarify, whether dealing in securities is a regulated activity depends on two conditions. First, it's done for others. Second, profit is earned specifically from this activity. Suppose now there's a handsome secretary without a license who buys stocks for his boss. Has the handsome secretary committed an offense? If the boss wants to buy stocks but is too busy and asks the handsome secretary to do it, then it's not illegal because the handsome secretary does not receive a commission from the securities transaction for buying stocks for his boss, so it's not considered a regulated activity. However, if the boss pays a commission to the handsome secretary due to the securities transaction, then the handsome secretary is operating without a license, which is a violation. As I just mentioned, dealing in securities is done for others and profit is made. What does this include? Acquiring securities, disposing of securities, that is, buying and selling securities. Whether buying or selling, both are considered dealing in securities. Subscribing for securities is also securities trading. Underwriting securities, that is, when a company issues securities, it needs to raise sufficient funds. If it can't sell, it will find someone to underwrite and take all the stocks. That person is called an underwriter. The underwriter and the company issuing securities discuss details in advance, including quantity, price, underwriting costs, etc. The distribution of securities during underwriting is also considered as dealing in securities. In addition, if the purpose of the agreement is to help others profit from securities, it also belongs to dealing in securities. For example, options allow the holder to buy or sell securities at a specific price during a specific period, and it's not directly buying or selling securities. Regarding the licensing system of the SFC, Securities and Futures Commission, dealing in securities includes transactions on the SEC, the Stock Exchange of Hong Kong Limited, and other transactions conducted in Hong Kong. In other words, securities transactions conducted in Hong Kong will be regulated by the SFC. We've mentioned, dealing in securities must be done for others, including securities trading activities that are part of company business, helping others buy or sell, or underwriting securities, etc. So, under what circumstances is it not considered securities trading? Operating exchanges and clearing houses, such as SEC, the Stock Exchange of Hong Kong Limited, and HKSI, Hong Kong Securities Clearing Company Limited, and authorized ATS, Automated Trading Service, are not considered dealing in securities. This is because exchanges and clearing houses only provide a safe and reliable third-party counterparty trading platform for investors. What does this mean? For example, if you want to buy stocks now, there are people who want to sell stocks. One buys and one sells. You can directly establish a purchase and sale contract, right? But if the seller defaults and you've already paid the money, what can you do? In this situation, you would have to figure out ways to recover your losses, but if there's a third party, such as a clearinghouse involved, both the buyer and seller each sign a contract with them, turning one purchase and sale contract into two, with both parties signing contracts with the clearinghouse. At this point, if the seller defaults, it's the clearinghouse's problem. They will take responsibility for recovery. In this situation, the transaction is safer and more reliable. Although operating exchanges, clearing houses, and automated trading services involve securities transactions, they are not considered dealing in securities. A person dealing in securities through a licensed corporation or registered institution as a principal, which means intermediaries buying and selling securities for that person, is also not considered as dealing in securities. As we've mentioned before, regulated activities involve getting paid for doing things for others. Buying and selling securities without getting paid is not considered dealing in securities. Issuing prospectuses by issuers is also not considered dealing in securities. Issuing a prospectus means that a listed company needs to provide a document that informs everyone of the specific details of the stock, such as the number of shares issued, issue price, issue date, purpose of fundraising, etc., inviting the public to invest in the stock. This is not done for others, and so is not considered dealing in securities. The issuing of an advertisement or invitation authorized by the SFC, Securities and Futures Commission, by intermediaries, or the issuance of advertisements or invitations by open-ended fund companies for their own shares, are also not considered dealing in securities. Another type is a trust company acting for a CIS, collective investment scheme. These trust companies only safeguard assets for the client, act on the instructions of the investment manager, and do not receive specific compensation from securities trading, so they are not considered dealing in securities. Lastly, if dealing in securities is entirely incidental to Type 4 advising on securities, Type 6 advising on corporate finance, or Type 9 asset management, it's also not considered dealing in securities. For example, if you hold a Type 9 license now and manage assets for a client, the client needs you to buy and sell securities for him to manage his assets. In this situation, buying and selling securities is completely incidental to asset management activities, and the client does not pay any additional commission because of this, so it's not considered dealing in securities. We've just talked about situations that are not considered dealing in securities, so who will conduct the Type 1 regulated activity dealing in securities? It includes: first, a participant of the SEC, the Stock Exchange of Hong Kong Limited. SEC is the main securities trading venue in Hong Kong, and the prerequisite for applying to become a participant of the SEC is to obtain a license for Type 1 regulated activity. Second, another securities dealer who is not a participant of SEC but carrying out dealing in securities in Hong Kong. Remember, the SFC, Securities and Futures Commission licensing system regulates securities trading conducted in Hong Kong, so as long as securities trading is conducted in Hong Kong, a license is required. Third, a licensed representative of the aforementioned SEC participants and securities dealers. They are the ones who actually operate securities trading, so they also need a license. Fourth, an AFI, authorized financial institution and its associated persons, registered with the SFC for securities trading, similar to licensed corporations, i.e. staff who are on a register maintained by the HKMA, Hong Kong Monetary Authority. Fifth, a portfolio managers holding a Type 1 license as a securities dealer. Sixth, a securities introducing agent who specialize in introducing securities futures business to securities dealers, so they also need a license for Type 1 regulated activity. Generally, there are these 6 types of people mentioned above. We've just mentioned approved introducing agents, so let's talk about what is an approved introducing agent. Approved introducing agents are a type of securities and futures dealer. They are approved by the SFC, Securities and Futures Commission, to become approved introducing agents. Approved agents involved in securities business are securities introducing agents. What do? They provide channels for clients to buy and sell securities, i.e., informing the client where to buy and sell securities, or helping the client find SEC, the Stock Exchange of Hong Kong limited participants or securities dealers who can conduct securities trading. Therefore, turning it around, approved introducing agents can also help exchange participants or other licensed dealers find clients. Remember, approved introducing agents are not allowed to hold client assets. It's like a professional introduction agency, purely introducing a client to which company to do things, or helping some companies find people. Unless the approved introducing agent is involved in fraud or serious negligence, they are not required to bear legal responsibility. As we said earlier, securities introducing agents need to hold a license for Type 1 regulated activity. Since they are engaged in regulated activities, i.e., getting paid for doing things for others. Therefore, approved agents are bound to charge a special fee based on the introduction they provide. If I introduce a friend to Broker Chan, but I don't take money from my friend and I don't take money from Broker Chan, in this case, I'm not an approved introducing agent because I don't have remuneration. But if I get paid because of the introduction, whether I take money from my friend or I take money from Broker Chan, then I have remuneration, it becomes a business, and I need to get a Type 1 license to do it. The risk undertaken by approved introducing agents is limited, so the SFC also allows them to maintain a lower level of liquid capital, and they do not need to maintain paid-up share capital. So, what exactly are larger entities? Larger entities consist of one or more specific types of companies, including a securities dealing company, which transacts the major part of dealing in securities in Hong Kong and elsewhere for the group. To engage in securities transactions in Hong Kong, a Type 1 license is required. A participant of the SEC, the Stock Exchange of Hong Kong Limited, which is approved by the HKEX, Hong Kong Exchanges and Clearing Limited, allowing them to conduct securities transactions on the SEC. Other companies within the larger entity can conduct securities transactions on the SEC through this participant. Similarly, to engage in securities transactions in Hong Kong, a Type 1 license is required. A participant of the HKFE, the Hong Kong Futures Exchange, which is approved by the HKEX, allowing them to conduct futures transactions on the HKFE. Just like the former, this is a channel through which other companies in the larger entity can conduct futures transactions on the HKFE, requiring a Type 2 license. An asset management company, which are primarily involved in managing, marketing, and distributing funds, requiring a Type 9 license. An SMF, Securities Margin Financing Company, which lend money to investors to buy securities, requiring a Type 8 license. A finance company, which perform financial functions for the group. A group holding company, usually, they focus on controlling equity, managing and directing the operation of the entire enterprise. The second category of regulated activities is dealing in futures contracts. So what is a futures contract? According to Schedule 1 of the SFO Securities and Futures Ordinance in Hong Kong, a futures contract means a contract or an option on a contract made under the rules or conventions of a futures market. But if it is the option on other contracts, like bonds, it will be a security. Remember, this is one of the differences between Hong Kong and other securities markets. And interests, rights, or properties specified by the Financial Secretary as futures contracts are also futures contracts in Hong Kong. In other words, if the Financial Secretary defines a certain financial product as not a futures contract, then it is not. So, what are the characteristics of a futures contract? First, it must be a contract entered into on an exchange. Second, the transaction will be completed in the future. What does that mean? That means both parties, the buyer and seller, agree to deliver a particular commodity asset at a specific time in the future. Compared to spot contracts, when you buy futures, you don't make immediate delivery. Instead, the delivery takes place at the expiration of the contract. For example, a jeweler expects that he will need 1,000 ounces of gold in the next 6 months, but is worried that the price may rise, so he hopes to lock in the current price ahead of time. So, he buys a gold futures contract, which allows him to buy 1,000 ounces of gold at a price of $1,500 per ounce 6 months later. This is a futures contract. As we mentioned earlier, there are 3 types of futures contracts in Hong Kong, one of which is a contract or an option on a contract made under the rules or conventions of a futures market. In this kind of contract, both the buyer and the seller have an obligation to buy or sell a specific asset at a predetermined price at a certain time in the future. Therefore, regardless of how the price fluctuates, by the delivery date, the buyer has to buy the asset at the contract price, and the seller has to sell the asset at this price. Both sides, the buyer and the seller, must buy and sell, sharing equal responsibility. Based on the type of asset, this type of contract can be further divided into physical delivery contracts, that is, futures contracts that deliver physical assets. What you hear about all day on TV, such as Brent crude oil, WTI, etc., are all types of futures. Suppose the buyer, Chan Tai Man, and the seller, Li Xiaoming, sign a contract to trade 1,000 barrels of crude oil at a specific price, for example, $68.50, a month later. On the delivery date a month later, the buyer, Chan Tai Man, and the seller, Li Xiaoming, will have to conclude through physical delivery. One must buy, one must sell, both sides share equal responsibility. Another type is cash-settled contracts, that is, futures contracts settled in cash. When the contract expires, the buyer and the seller won't make a physical delivery. The contract will specify a certain asset and set a price. Cash settlement is made based on the difference or change between the contract price and the actual market price at a specific time in the future. Are there any examples? Index futures is this kind of contract. Suppose you buy S&P 500 futures contract at a contract price of $3,000. At the contract's expiration, the S&P 500 index rises to 3,100. At this point, as a buyer, you can make a profit of $100 from the seller, that is, the market price of $3,100 minus the contract price of $3,000, the buyer gets $100. Conversely, if the S&P 500 index falls to 2,900, then as the buyer, you need to pay the seller $100, that is, the contract price of $3,000 minus the market price of $2,900, the buyer loses $100. On the basis of futures contracts, another type of futures contract has been derived: options on futures contracts. The key to options is, the buyer has the right to exercise and can choose whether or not to transact. If a transaction is made, the option contract will convert into a futures contract. For example, a person named Ng Quang Tak is optimistic about the trend of crude oil, expecting the price of crude oil will continue to rise. Ng Quang Tak is poor and doesn't want to take on too much risk, so he chooses to buy options on a crude oil futures contract. Suppose the exercise price of this option contract is $70 per barrel and the validity period is 1 month. If the price of the crude oil exceeds $70, Inquantac can choose to exercise the option, convert the option contract into a futures contract, and buy the crude oil futures contract at $70 per barrel. Inquantac can also choose not to exercise the option and resell this option contract to others. On the contrary, if the price of crude oil does not exceed $70, Inquantac can no longer exercise the option. In this case, Inquantac's loss is the cost paid for purchasing the option, which is the option premium, and he will not suffer greater losses due to the fall in oil prices. The option contract gives the buyer the right to deliver, and apart from the option fee, there is no obligation. For the seller, they must act according to the buyer's wishes. If the buyer chooses to exercise the right, then the seller must fulfill their obligations. It's just like buying a cash coupon. As a buyer, after you bought the cash coupon, you have the right to choose to use it or not. As the seller, as long as the cash coupon has not expired, you have to accept the cash coupon. What are some of the operational features of options on futures contracts in the futures market? First, such contracts or options are novate or guaranteed by a CCP, central counterparty under the rules or conventions of the market on which they are traded. In the Hong Kong futures market, the CCP is the clearinghouse, which carries out novation or guarantees. What does that mean? It means that the buyer and seller do not trade directly, but rather with the clearinghouse, the third party, or the CCP. For example, the crude oil contract between buyer A and seller B is not actually signed directly between A and B. Instead, A buys from the clearinghouse, and B sells to the clearinghouse. One contract becomes two. This is novation. What are the advantages? It mainly reduces transaction risk. If one party cannot fulfill the contract, for example, B, after a month, sees crude oil rising to $75 per barrel and does not want to fulfill the contract. At this time, the intervention of the clearinghouse can ensure that A buys 1,000 barrels of crude oil at $68.50 per barrel. Second, the obligations of the futures contract can be relieved before the contract expires. Using the example above, if B fulfills the contract on the delivery date and delivers 1,000 barrels of crude oil, they will lose $6,500. If they don't want to lose so much, what can they do? For example, 15 days before the due date, B finds that the price of crude oil has risen to $70 per barrel, and they expect it to continue to rise. At this time, B can choose to square off in advance, sign another contract with the clearinghouse, and buy 1,000 barrels of crude oil at a price of $70 per barrel. Sell once, buy once, end the transaction. The 1,000 barrels of crude oil originally due to be delivered to A on the delivery date will be delivered by the clearinghouse on behalf of B. In this situation, the obligation to deliver 1,000 barrels of crude oil to A on the due date in the crude oil futures contract between B and the clearinghouse is relieved. And B stops the loss in time, losing only $1,500 in total. Before the contractual expiry date, most investors choose the appropriate time to square off, that is, to sell the bought futures contracts, or to buy back the sold contracts. By trading in equal quantities and opposite directions, they hedge the original futures contracts to relieve responsibility. So, what is a futures market? Through the introduction above, I believe everyone has a certain understanding. The futures market is a trading platform, specifically acting as a guarantor, witness, and introducer for parties buying and selling futures. So, what counts as dealing in futures contracts? Remember, dealing in futures contracts is a type of regulated activity. They are always performed on behalf of others, and specifically for a fee. So, what activities are considered dealing in futures contracts? These include entering into futures contracts, acquiring futures contracts, disposing of futures contracts, that is, buying and selling futures contracts. So, under what circumstances are not defined as dealing in futures contracts? Firstly, operating a clearinghouse does not count as dealing in futures contracts. Because the clearinghouse only performs novation, helping investors and securities firms buy and sell futures contracts, it does not belong to dealing in futures contracts. Secondly, if a licensed corporation or registered institution conducts transactions on its own behalf, that is, the intermediary places an order to buy and sell futures contracts for itself, then it is not considered dealing in futures contracts. As we have mentioned, the regulated activities stipulated in the SFO Securities and Futures Ordinance involve paid services for third parties. Doing things for oneself naturally doesn't count as a dealing in futures contracts. Thirdly, persons acting as principal and who deal with PIs in dealing in futures contracts traded otherwise than on a recognized futures market are not considered dealing in futures contracts. Futures trading must take place in a recognized market. Fourthly, licensees of the Type 9 regulated activity asset management or related persons. If they buy and sell futures for clients that are purely incidental to asset management activities and do not charge additional fees, it will not be regarded as dealing in futures contracts. Other situations include transactions conducted in specific markets specified in sections of the Commodity Exchanges Prohibition Ordinance or members of a commodity exchange in operation on June 20, 1973 conducting transactions on those exchanges, persons entering into market contracts, etc., are not considered dealing in futures contracts. The third regulated activity is leveraged foreign exchange trading. Let's first understand what foreign exchange trading is. Foreign exchange trading is when a person enters into a contract or induces others to enter into a contract, which includes: first, exchanging currency with another person. Second, deliver foreign currency to another person or credit the account of another person with foreign currency. If the above characteristics are met, it is considered foreign exchange trading. For example, Mrs. Chan is supporting a young man and wants to travel to Japan with him. Mrs. Chan has 100,000 Hong Kong dollars, so she gives these 100,000 Hong Kong dollars to the bank. The bank then exchanges it for an equivalent value of Japanese yen for Mrs. Chan. This is called foreign exchange trading. What is leveraged foreign exchange trading? Leveraged foreign exchange trading is when an intermediary helps another person buy and sell foreign exchange contracts. In the process of trading, the intermediary provides financial accommodation, lending money to this investor, increasing the principal, and investing in foreign exchange using the leverage effect. This investor buys a foreign currency in the form of margin, anticipating that this currency will strengthen or weaken relative to another currency. Ultimately, whether they gain or lose depends on price changes. The contract is not executed on an exchange. It is called leveraged foreign exchange trading. One thing to note: banks or AFIs, authorized financial institutions, do not need to obtain a license or register to engage in leveraged foreign exchange trading. Why? Because banking business itself involves a large amount of lending and foreign exchange trading. Because banks already have a large amount of lending business, they, as AFIs, do not need to obtain a license or register to engage in these activities. Is that all right? So what is a LFE, leveraged foreign exchange contract? In a LFE contract, the parties agree and commit to certain terms, which may include: first, the parties will adjust based on the change in value of one currency relative to another appreciation or depreciation. Foreign exchange trading involves exchange rates, i.e., the exchange ratio between currencies. As we all know, exchange rates can fluctuate. For instance, one British pound to Hong Kong dollars sometimes is $9, sometimes $10. The point here is that LFE contracts will adjust the value of the contract according to exchange rate fluctuations. If you buy a contract predicting that the pound will appreciate, you expect the pound to appreciate against the Hong Kong dollar. If the pound indeed appreciates, then the value of your contract has increased, and now you can sell pounds at a higher price. This adjustment changes the contract value based on exchange rate changes. Second, Party A in the contract promises to pay Party B a specified amount of money, or deliver a specified quantity of goods, and this amount or quantity is determined by the value change of one currency relative to another. What does that mean? It's essentially a bet. For example, Mrs. Chan and Mr. Lee are betting on how the exchange rate of the US dollar to the Hong Kong dollar will change. If the exchange rate of US dollar to HK dollar rises from 7.8 to 7.9 next month, then Mrs. Chan has to pay Mr. Lee 1,000 Hong Kong dollars. Conversely, if the exchange rate of US dollar to HK dollar drops from 7.8 to 7.7, Mr. Lee has to pay Mrs. Chan 1,000 Hong Kong dollars. Third, Trader A promises to deliver a certain amount of currency to Trader B at a specific price at a future time. The principle is the same as pre-ordering. For instance, the pre-order price for the limited edition Gundam model is $1,000, pay on delivery. The model is limited, so you expect the price of the model will rise, so you immediately place an order. 3 months later, when the model is being resold for over $10,000, you only paid $1,000 for it, so you've made a profit. Similarly, if you believe the US dollar will depreciate, you buy a leveraged foreign exchange contract with a trade in 3 months at an exchange rate of $1 US to 7.83 Hong Kong dollars. 3 months later, regardless of whether the US dollar rises or falls in the market, you have to trade at this amount. There's a special feature of LFE, leveraged foreign exchange contracts. On the value date, if both parties agree, the settlement of the contract can be deferred indefinitely. For instance, Mrs. Chan buys a leveraged foreign exchange contract based on the US dollar to Japanese yen, with the payment date set for a month later. When the payment day arrives, Mrs. Chan finds she can't afford it because she gave all her money to Mr. Wong next door. Seeing that Mrs. Chan is a beautiful woman, the other party to the trade agrees to postpone the contract settlement. So when does the settlement take place? In the first scenario, the client agrees to take physical delivery, both parties are prepared, and agree to settle in the currency. According to the agreed exchange rate, Mrs. Chan takes her US dollars and exchanges them for the other party's yen. Or in the second scenario, they enter into a netting contract, with the result that the obligation under the original contract becomes one of net settlement. A netting contract. A net amount is calculated based on the difference between the exchange rate stipulated in the contract and the actual market exchange rate, and it's paid by the party whose currency has depreciated to the other party. For example, at the time of settlement, if the value of the US dollar against the yen has dropped, Mrs. Chan, who holds US dollars, has to pay the net amount to her counterparty. What situations do not fall under leveraged foreign exchange trading? Transactions conducted by AFIs, authorized financial institutions, or central banks. Banks are already involved in a large amount of foreign exchange buying and selling and lending activities, and central banks need to implement monetary policies, which may require conducting foreign exchange transactions to manage the supply of money and maintain financial stability. Therefore, transactions conducted by these two types of institutions are exempt and are not considered leveraged foreign exchange trading. Exchange transactions under the Money Changers Ordinance, that is, currency exchange transactions conducted by money exchange merchants with others. When these money exchange merchants conduct foreign exchange transactions, they are already restricted and regulated by the Money Changers Ordinance, so they can be exempted and not considered as leveraged forex trading. Licensees holding Type 1 or Type 2 licenses or related persons, their leveraged foreign exchange trading are completely incidental to their securities and futures contract transactions, so they can also be exempted. For example, Broker Chan has a client who wants to buy a forex option trading. In order to help the client buy this derivative, Broker Chan may need to conduct leveraged foreign exchange trading first, since the leveraged forex trading is conducted to execute the main transaction. Forex option trading, and Broker Chan does not charge any additional fees. It is not considered as leveraged foreign exchange trading. What are market intermediaries in LFE, leveraged foreign exchange trading? The first kind is LFE traders. As the name suggests, they are corporations engaged in LFET, leveraged foreign exchange trading, and they need to apply for and obtain a Type 3 license from the SFC, Securities and Futures Commission, to operate. LFE traders not only provide a platform for foreign exchange trading, but also provide financial accommodation, i.e., lending money to clients for investment. For example, CES Forex, HK, Limited, is one of the LFE traders in Hong Kong. The second type of market intermediary is approved introducing agents. As we mentioned before, an approved introducing agent only serves as an introducer, passing on clients' trading orders to other traders. That is to say, they only introduce clients to other traders and do not directly participate in the transaction. Since they do not participate in transactions, they do not hold or control client assets, nor do they handle discretionary accounts. So, what is a discretionary account? It's where investors authorize experts to operate their specified accounts completely. In simple terms, approved introducing agents only do introductions and don't touch transactions or client assets. Therefore, the capital requirements imposed by the SFC, Securities and Futures Commission, for them are lower than full LFE traders. However, approved introducing agents still need to obtain a Type 3 license to conduct related leveraged forex trading business. The third type of market intermediary is known as recognized counterparties. Recognized counterparties are generally substantial institutions, which may include AFIs, authorized financial institutions, i.e., banks, which are considered approved counterparties. In certain transactions, a Type 3 licensee and another Type 3 licensee acting as counterparties are considered each other's recognized counterparties. For example, let's say that a leveraged foreign exchange trader A wants to buy Japanese yen with $1 million and another leveraged foreign exchange trader B also wants to sell the same amount of Japanese yen in exchange for US dollars. As a result, A and B conduct the transaction. A buys Japanese yen, B buys US dollars, and A and B become each other's recognized counterparties. There are also other institutions recognized by the SFC, Securities and Futures Commission, as recognized counterparties. Transactions between leveraged foreign exchange traders and recognized counterparties can receive special treatment, such as an recognized counterparty not being considered a client of a leveraged foreign exchange trader. The fourth type of market intermediary is the AFIs, authorized financial institutions. AFIs are regulated by the HKMA, Hong Kong Monetary Authority, because they primarily engage in large volumes of interbank foreign exchange business, deal in foreign exchange trading generally for a wide range of customers, and also conduct leveraged foreign exchange trading for retail clients. Because AFIs are already regulated by the HKMA, they do not have to comply with the licensing regulations of the SFC, Securities and Futures Commission. What are some examples of AFIs? For example, HSBC, which provides all the aforementioned services. How should leveraged foreign exchange trading disputes be resolved? If the client requests, the licensed trader can resolve the issue through arbitration. The SFC, Securities and Futures Commission, has established a subsidiary legislation, the Securities and Futures, Leveraged Foreign Exchange Trading, Arbitration, rules, specifically for handling disputes related to leveraged foreign exchange trading. It outlines the procedures for resolving disputes through arbitration, including the constitution of the arbitration panel, the selection of an arbitrator from the panel to hear a dispute, and the rules relating to the arbitration proceedings, their termination, and the making of awards. I believe everyone has some impression of the Type 4 regulated activity advising on securities and the Type 5 regulated activity advising on futures contracts. So, under what circumstances are we considered to be engaged in these two regulated activities? Providing advice on the buying and selling of securities and futures, such as a broker advising you on what price to buy or sell stocks or futures, or issuing analyses or reports in response to the buying and selling of securities and futures with the aim of assisting investors in dealing with securities and futures. If the aforementioned activities involve commercial elements, i.e., receiving remuneration for providing services, then this is a regulated activity advising on securities and futures contracts. However, if your neighbor Mrs. Chan buys stocks, and we often chat about when to buy which stocks, would this be considered a regulated activity? If it's just a pure exchange of investment experiences and doesn't involve any commercial interests, then it is not considered a regulated activity. Providing advice on securities and futures contracts. So what kind of advice is actually being provided? For example, should securities and futures transactions be carried out? Which kind of securities and futures should be bought or sold? When should trading take place? Under what conditions should trading be conducted? These all fall under the advice on securities and futures contracts. However, please note, providing advice on securities and futures contracts does not involve Type 6 providing advising on corporate financing or Type 10 providing credit rating services. The advice is strictly limited to general securities and futures trading. Some individuals do not need to be licensed when providing advice on securities and futures contracts. This includes professionals such as solicitors, counsel, accountants, trust companies, licensed asset managers, when providing advice on securities and futures contracts purely as a part of their professional capacity, do not need to obtain a license. For example, an accountant might need to perform financial analysis for a client and in the process of giving advice that involves elements of securities or futures. In such cases, no license is required. However, if the accountant charges extra for providing advice on securities or futures, then a license would be required. Financial journalists or broadcasters providing investment advice to the public or issuing investment analysis or reports. For instance, if they write about the future trends of certain securities in their financial news reports, they would not need a license. Corporations providing advice to their wholly owned subsidiaries or parent companies. As this is internal investment strategy advice for their own purposes, not for others, and there are no fees involved, they do not need to be licensed. License holders for Type 1 dealing in securities and Type 2 dealing in futures contracts. When they provide the aforementioned advice purely as a part of these two types of activities, they do not need an additional license. For example, a stockbroker advising a client on when to trade, what terms are involved in buying certain stocks, without charging extra, would not need a license. The Type 6 regulated activity is advising on corporate finance. What activities belong to advising on corporate finance? Generally speaking, corporate finance advisors provide advice to companies listed or about to be listed on the SEC, the Stock Exchange of Hong Kong, such as the requirements for listing securities in the San Francisco Airport Securities and Futures Ordinance, how to comply with the guidelines of the SFC Securities and Futures Commission, and how to proceed with listing, etc. Corporate finance advisors also provide advice to those about to carry out acquisitions, mergers, and share repurchase activities, advising on how to conduct a public offering or acquire securities. For example, if a listed company plans to offer shares to the public, it would need professional advice to determine the price, timing, and conditions, etc. When shareholders face acquisition, merger, and share repurchase activities, they can also ask corporate finance advisors for advice, considering whether or not to accept the acquisition. If a listed corporation or public company plans to restructure, i.e., there are significant adjustments in the organizational structure or operation of the company, which may involve mergers, debt restructuring, etc., they may also need a corporate finance advisor to provide advice on securities, evaluating the impact of the restructuring on the company's stock price, shareholder rights, etc. In simple terms, corporate finance advisors provide advice on acquisition, merger, and share repurchase activities, whether planning to go public, acquiring other companies, or being acquired by other companies. These situations may require the advice of a corporate finance advisor. So, do corporate finance advisors charge fees? Those who charge you need to get a license, and those who don't charge you don't need a license. The Type 7 regulated activity is providing automated trading services. So, what does providing automated trading services mean? Providing automated trading services means any automated system that operates through electronic facilities provided by non-exchanges or clearing houses. Simply put, it involves creating electronic trading systems, such as matching systems, automatically matching buy and sell orders, providing services similar to those of an exchange or clearing house, and carrying out off-exchange securities, futures buying and selling, and clearing. For example, black pools that anonymously match large-scale stock transactions for buyers and sellers, or platforms for buying and selling A-shares and U.S. stocks. Therefore, automated trading services can provide an over-the-counter trading mechanism for securities and futures contracts. If you want to provide automated trading services, you must obtain a license from the SFC Securities and Futures Commission. The Type 8 of regulated activity is securities margin financing. So, what does securities margin financing mean? It is about providing financial accommodation for investors, that is, lending money to investors for the purchase and sale of stocks. This is referred to as securities margin financing. This service facilitates investors in obtaining and continuing to hold securities. Please note, the following situations are not considered as securities margin financing. Financial accommodation provided for issuing IPOs, initial public offerings, is not considered as securities margin financing. During underwriting or offering, if money is lent to the investor enabling the investor to participate in the new stock issuance, then this is not considered as securities margin financing. Financial accommodation provided by Type 1 licensee. Because customers may not have enough money when conducting securities transactions, Type 1 licensed individuals provide them with financial accommodation to assist them in securities trading. Since the provision of financial accommodation is entirely incidental to the Type 1 regulated activity, it is also not considered as securities margin financing. If a collective investment scheme provides financial accommodation for investors, it is also not included in securities margin financing. For example, there is currently an investment trust, and an investor wants to increase his investment in this investment trust but doesn't have enough funds. Therefore, the investment trust provides financial accommodation to the investor, enabling him to buy more units of the investment trust. In this situation, it is not considered as securities margin financing. All financial accommodation provided by AFIs, authorized financial institutions, that is, banks lending you money to buy stocks, is not considered as securities margin financing. Why? Because banks themselves provide loans. Shareholders who hold not less than 10% of issued shares, providing financial accommodation to the company, are also not considered as securities margin financing. That is, the shareholder lends money to the company, and the shares held by the shareholder are not less than 10%. This method is also not considered as securities margin financing. In addition, an intermediary introducing financial accommodation provided by a corporation with which they are connected is also not considered as securities margin financing. In this situation, the intermediary is merely making an introduction, not directly lending money to the investor, so it is not considered as securities margin financing. What are the special conduct requirements for securities margin financing? First, before lending money to a client, you need to vet the creditworthiness of the client, such as income, assets, past credit records, etc. Moreover, set how much money to lend to them, what is the lending ratio, and the procedure for margin call based on the client's credit. How to add margin when the client's margin is not enough. Secondly, there must be prudent risk management and internal controls. This includes monitoring the use of clients' securities as collateral for borrowing money from banks, and checking if it has exceeded the limit, and whether there are too many loans concentrated in a certain security or on a certain client, and if there is a possibility of triggering concentration of exposure, etc. Thirdly, it is necessary to monitor the business operations through ongoing management reports, such as the loan balances of material clients, details of collateral held, margin ratios, and loan balances which are at risk because of concentrations of exposure to securities collateral. Fourth, in accordance with the regulations of the contract notes rules, disclose the account status to the clients. On the contract note and monthly statements, it is necessary to show that the client's account is a margin account. Disclose all details of the financial accommodation provided to the client on the account statement, including the nature of the financial accommodation, credit limit, expiry date of the accommodation, basis of interest calculation, as well as the quantity, market value, and margin ratio of securities collateral held. Fifth, separate the management of margin and cash client accounts. Sixth, margin loans cannot exceed the current value of the securities, meaning if a client's stock is only worth $1 million, you cannot lend him $1.1 million. Seventh, comply with sole business requirement, only lend money to clients for purchasing and continuing to hold listed securities. Note: it does not trade on behalf of clients. Holding a Type 1 license can fully provide margin financing, while holding a Type 8 license cannot engage in securities trading. Eighth, written confirmation and authorization from the client are required, including signing a written margin client agreement with the client before providing margin services and disclosing risks, before handling client securities, repledging customers' securities collateral. Authorization from the client is also required. When securities dealers and securities margin financiers handle client securities, they need to comply with the client securities rules and must be subject to the client's written authorization. For example, before they can repledge client securities collaterals, they must obtain the client's written authorization and consent. A licensed corporation must not start trading on margin for a client before entering into a clear, written margin client agreement with the client. The client agreement must be prepared in a language understood by the client. So, what should the margin agreement include? First, there needs to be a clear risk disclosure statement so that the client understands the potential risks of the loan. The method of calculating margin loan interest, letting the client know what formula is used to calculate the loan interest. The repayment time and method of the loan, listing when and how the client should repay the money. The use of the client's collateral, clarifying under what circumstances the client's collateral will be handled. Specify the loan limit and lending ratio, including whether different types of securities use different lending ratio. Margin call procedures, for example, when to issue a call for additional margin and what the consequences of failing to meet a margin call. The notification procedure when there is a margin deficiency, that is, when the margin is not enough, the securities margin financier needs to notify the client before they can sell the client's securities collateral. These terms should be included in the margin agreement. Securities dealers and securities margin financiers need to comply with the requirements for repledging clients' securities collateral. So, what is repledge? When conducting securities margin financing, the client provides securities as collateral to the securities margin financier to get a loan, and borrows money from the securities margin financier to invest. Suppose the securities margin financier isn't very wealthy, they may repledge the client's securities collateral to borrow money from banks or other intermediaries, which is repledge. So, what are the requirements for repledge? First, a limit of 140% on repledging client securities collateral. That is to say, when a securities margin financier repledges the client's securities collateral to other institutions, its total value cannot exceed 140% of the original collateral value. For example, if a client pledges securities worth $1 million, then the total value of the securities margin financier's repledge cannot exceed $1.4 million. Second, certain changes to relevant haircut percentages. Because the market changes throughout the day, it can affect the value of the securities collateral, so it might be necessary to adjust the deduction percentage of the collateral value. For example, if the deduction percentage for ABC stock is 10%, and now ABC Company is facing a bankruptcy crisis, leading to increased risk for those holding ABC securities, so the securities margin financier might increase the deduction percentage to 15%. Third, requirements for additional disclosures to margin clients about the risks of pooling and pledging. The securities margin financier needs to clearly express to the client their stocks will be repledged, which could involve potential risks. The Type 9 regulated activity is asset management. So what is asset management? Simply put, it involves managing assets for others, where investors typically do not participate in daily management. According to the SFO Securities and Futures Ordinance, asset management includes two things. First, real estate investment scheme management, that is, providing a service of operating a CIS, collective investment scheme for another person. Moreover, the assets managed under the scheme consists primarily of immovable property, i.e., managing properties. Second, securities or futures contracts management, as the name suggests, involves providing services to manage securities or futures investment portfolios for others. Note: we often assume that some things fall under asset management, but that's not always the case. What does this include? MPF, mandatory provident fund schemes, occupational retirement schemes, categories of insurance business related to insurance contracts, including some investment-linked insurances. These are not considered part of asset management, all right? What are the functions of the SFC, Securities and Futures Commission, in relation to asset management? First, the SFC is responsible for authorizing and supervising CISs, collective investment schemes, such as unit trusts, managed funds, and retirement schemes. If a company or institution wants to establish or promote a CIS, they need to first obtain authorization and be supervised by the SFC. Second, the SFC also needs to issue licenses and carry out supervision for intermediaries engaged in asset management, i.e., Type 9 regulated activity, as well as other professionals in the industry providing advisory services, i.e., Type 4 and Type 5 regulated activities. The Type 10 regulated activity is providing credit rating services. Before we begin, let's first understand what credit rating is. We often hear about Standard & Poor's, Moody's. In fact, these are credit ratings. A credit rating is a method of assessing creditworthiness, evaluating credit through a rating system. The main subjects of its assessment include four types: a person other than an individual, such as companies, debt securities, including debenture stocks, notes, etc., preferred securities, i.e., preference shares, and an agreement to provide credit, such as credit cards or loans. Generally speaking, credit ratings are conducted by professional credit rating agencies. The rating result is expressed in specific grades, such as AAA, B+, and so on. So what exactly is a credit rating service? Generally speaking, credit rating services mainly provide objective credit ratings for companies or loan agreements, allowing investors to decide whether or not to invest. Therefore, preparing credit ratings for: first, dissemination to the public, that is, to make credit rating information public to everyone. If a credit rating company, such as Standard & Poor's, publishes the credit rating of a company or government, then it is providing a credit rating service. Secondly, distribution by subscription, that is, to provide credit rating information to specific subscribers, which is also considered as providing credit rating service. So does providing a credit rating service require a fee? Of course, it does. It's done for others and it's paid, so it's a regulated activity. What are the situations that do not count as providing credit rating services? If a credit rating is made specifically for an individual, and the credit rating information is only provided to this individual without any intention of making it public or available to subscribers, then it does not count as providing credit rating services. For instance, if a company only creates credit ratings for internal use, like a bank evaluating counterparty risk, it may not need to comply with licensing regulations. Furthermore, gathering, collating, disseminating, or distributing information concerning the indebtedness or credit history of any person does not constitute the provision of credit rating services. For example, consumer credit reference agencies that prepare opinions regarding the creditworthiness of individuals do not need to comply with licensing regulations. Regulated activities are not set in stone and may increase in the future. The Securities and Futures Amendment Ordinance 2014 will introduce Type 11 regulated activity dealing in OTC derivative products or advising on OTC derivative products, and Type 12 regulated activity providing client clearing services for OTC derivative transactions. These two newly added activities have not yet been implemented. You can see the screenshot from the Securities and Futures Commission website on the right. Currently, there is no need to license or register for the Type 11 and Type 12 regulated activities. In addition, the Type 7 and Type 9 regulated activities are expanded to cover OTC derivatives. Next, let's talk about derivative transactions. When did the regulation start? And what is the current regulatory situation? In 2008, due to credit defaults leading to a decline in the value of corresponding financial derivatives, a global financial crisis was triggered. Because of this, regulatory agencies around the world advocated for central clearing of OTC, over-the-counter derivatives, to increase the transparency of the OTC derivatives market, reduce counterparty risk, and thus conduct systemic risk regulatory assessments. Key factors in regulating and controlling OTC derivative transactions include: first, identify which OTC derivative transactions need to be reported to a centralized information repository and are cleared by a CCP, Central Counterparty Clearing Facility. Second, identify who is to report, that is, which entities or individuals must comply with the reporting requirements of OTC derivative transactions. Due to the lack of transparency in OTC transactions, it is necessary to confirm the transactions and report this transaction information to a centralized information repository. This can increase market transparency and help regulatory agencies better understand market risks. Central clearing can reduce the credit risk of transactions and reduce systemic risk. So what is the current regulatory situation in Hong Kong? Hong Kong established an OTC derivatives clearinghouse in 2013 and implemented the first phase of regulation in 2015. Licensed corporations are required to comply with regulations, mandatorily report certain swap rates and non-deliverable forward transactions, and fulfill record-keeping responsibilities. The second phase officially took effect in July 2017, expanding the range of products and transaction data that need to be reported. When does a licensed corporation need to report? There are three situations. First, when a licensed corporation enters into a specified over-the-counter (OTC) derivatives transaction as a counterparty, it is required to report according to regulations. For example, if the licensed corporation becomes the seller in the transaction and signs an options contract, it has to report. Second, if the licensed corporation conducts a transaction in a specified OTC derivative transaction in Hong Kong on behalf of an affiliate, it also needs to report. What does an affiliate mean? It's another company within the same corporate group as the licensed corporation. No matter where the affiliate is located, as long as the licensed corporation represents the affiliate in conducting OTC derivatives transactions in Hong Kong, it needs to report. For example, if the licensed corporation A in Hong Kong represents its American affiliate B in conducting OTC derivatives transactions, then A has to report. On the other hand, can an affiliate report on behalf of the licensed corporation? Yes, it can. If the affiliate reports on behalf of the licensed corporation, the affiliate must provide a written confirmation. Once the written confirmation is obtained, it can be regarded that the licensed corporation has fulfilled its reporting obligation. Third, if a licensed corporation loses its exempt status, it must also report. If the aggregate position of the licensed corporation is less than $30 million, it can be exempted and does not need to report. Conversely, if the aggregate position of the licensed corporation exceeds $30 million, the licensed corporation will lose its exempt status on that day and will permanently lose its exempt status. Once the exempt status is lost, the licensed corporation must fulfill its reporting obligation. Once the reporting obligation has been triggered, licensed corporations are required to report the following two types of information. First, all OTC, over-the-counter derivative transactions which have been previously entered into as counterparty and which remain outstanding. Second, subsequent events. After entering into a transaction, any events that may affect the transaction terms or the parties involved are referred to as subsequent events. In simple terms, if a transaction is not completed, licensed corporations still need to fulfill their reporting obligation. During this period, if any events occur that affect the transaction terms, i.e., subsequent events, they must also be reported until the transaction is completed. When reporting, what information needs to be provided by licensed corporations? This includes the particulars relating to the class or type of product to which the transaction belongs, the date the transaction is entered into, becomes effective and matures, particulars of the counterparties, clearing information, the references assigned to the transaction, particulars of the transaction and subsequent event. When should licensed corporations make reports? Generally speaking, reporting must be done on a T+2 basis, which means that licensed corporations are required to report within 2 business days after any transaction events occur. Additionally, information concerning the valuation of the transaction will need to be submitted on a daily basis. What happens if a licensed corporation loses its exempt status? They are given a grace period. Starting from the day the exemption is lost, they have 3 months to submit the specified data. This must include the transaction events that have occurred since the commencement of the grace period. What are the consequences if a licensed corporation violates the rules? The SFC, Securities and Futures Commission, may file a lawsuit with the court of first instance, and the licensed corporation may face a maximum fine of 5 million Hong Kong dollars. How do licensed corporations make reports? Licensed corporations can report through the electronic reporting system operated by the HKMA, Hong Kong Monetary Authority, known as the HKTR, Hong Kong Trade Repository. To become a member of the HKTR, licensed corporations need to obtain a LEI, Legal Entity Identifier, which is a unique identification code similar to HKID. The LEI is used to identify each legal entity participating in financial transactions. Therefore, when reporting, the LEI is used to enable the system to identify the identity of the licensed corporation. What should a licensed corporation do after the termination of OTC, over-the-counter derivative transactions? The OTCD, over-the-counter derivatives reporting rules specify that regardless of whether the transaction was conducted partly or wholly outside of Hong Kong, from the day of transaction termination, licensed corporations need to keep transaction records for at least 5 years. These records need to reflect that the licensed corporation has fulfilled its reporting duties and can be accessed at any time. Note that even if the licensed corporation is exempted and does not need to report, it still needs to keep records. And the relevant records must show that they meet the conditions of exemption. What are the consequences if the licensed corporation does not comply with this rule? The SFC, Securities and Futures Commission, is empowered to bring licensed corporations that breach the rules before the court of first instance. The maximum penalty that may be imposed by the court is 5 million Hong Kong dollars. Finally, let me remind you that not all OTC derivatives are regulated by the OTCD reporting rules, only those specified by the HKMA, Hong Kong Monetary Authority. To regulate OTC, over-the-counter derivatives transactions, one needs to conduct transaction reporting and central clearing. We have previously discussed the mandatory reporting obligations of licensed corporations regarding OTC derivatives transactions. Now let's talk about mandatory clearing obligations. To implement central clearing of OTC derivatives, the SFC, Securities and Futures Commission, has introduced a subsidiary legislation, the OTCD clearing rules, and has started implementing the first phase since September 1, 2016. This regulation requires certain specified derivatives to fulfill mandatory clearing obligations in order to manage the systemic risk caused by larger and more significant participants in the OTC derivatives market. The targets of the OTCD clearing rules are significant participants in the OTC derivatives market where both sides of the transaction are required to be involved, that is, dealer-to-dealer transactions. Dealers here include prescribed persons and financial services providers. Prescribed persons must exceed the clearing threshold to have clearing obligations. So, who are the prescribed persons? They are AFIs, authorized financial institutions, AMBs, approved money brokers, licensed corporations, and other persons who are specified in the OTCD clearing rules. And what are financial services providers? Financial services providers refer to persons who have been designated by the SFC as being actively engaged in activities relating to OTC derivative transactions or OTC derivative products outside Hong Kong, including all systemically important banks globally. The OTCD clearing rules target transactions between prescribed persons or between prescribed persons and financial services providers, and these transactions must fulfill mandatory clearing obligations. So, what is the mandatory clearing obligation? This means in relation to an OTCD, over-the-counter derivative transaction, prescribed persons are required to clear the transaction through a designated CCP, central counterparty within 1 business day after the transaction is entered into, unless a relevant exemption applies. Who acts as the CCP? It is either a recognized clearinghouse or a person authorized by the SFC, Securities and Futures Commission, to provide automated trading services. Compared to automated trading services, recognized clearinghouses can provide more protection. Therefore, the SFC expects recognized clearinghouses to act as the CCP. What happens if one fails to clear the transaction through the CCP in time? In such cases, the prescribed persons must terminate the transaction, otherwise, it would be in violation of the OTCD clearing rules. Take note that the failure to fulfill the clearing obligation does not affect the validity of the transaction, but there may be legal consequences for the violation. What OTCD, over-the-counter derivatives products, are subject to the clearing obligation? The class of product is interest rate swaps, IRS, with specified tenors. During the contract period, 2 parties agree to, based on a specified notional amount, exchange cash flows derived from the differential between rates. The IRS includes 3 products. First, fixed to floating IRS. That is, one party pays a fixed interest rate in exchange for the other party's floating interest rate. Second, floating versus floating IRS, also known as basis swaps. Both parties settle using 2 different floating interest rates. Third, overnight index swaps. That is, one party pays a fixed interest rate in exchange for the average of the other party's overnight interest rates. Remember, not all OTC derivatives need to fulfill clearing obligations. Only these 3 types of IRS products bear clearing obligations, so remember their names. Who exactly needs to fulfill the clearing obligation? As mentioned before, dealer-to-dealer transactions are subject to the clearing obligation, including transactions between prescribed persons and transactions between a prescribed person and a financial services provider. Therefore, both prescribed persons and the financial services provider have the clearing obligation. So, who are the prescribed persons? They include AFIs, approved financial institutions, i.e., banks, AMBs, approved money brokers, licensed corporations, and other persons who are specified in the OTCD clearing rules. If the prescribed person exceeds the clearing threshold, they will have the clearing obligation. So, what does a financial services provider mean? A financial services provider is a person engaged in OTC derivative transactions overseas and is designated by the SFC, Securities and Futures Commission. Basically, these financial service providers are large institutions, so there is no clearing threshold. If a prescribed person exceeds the clearing threshold, they need to fulfill the clearing obligation. What is the clearing threshold? It refers to the average total position of a prescribed person in OTCD, over-the-counter derivative transaction. Remember, the calculation includes only positions and products covered by the OTCD clearing rules. Currently, the clearing threshold is set at $20 billion. Once the clearing threshold is reached, the clearing obligation arises. Under what circumstances can the clearing obligation be exempted? If a prescribed person changes their business model or transaction portfolio, and their position falls below the clearing threshold by a specified amount for 12 consecutive months, they can submit an exit notice. If it's a licensed corporation, notify the SFC, Securities and Futures Commission. If it's an AFI, Authorized Financial Institution, or AMB, Approved Money Broker, notify the HKMA, Hong Kong Monetary Authority. After issuing the notice, the prescribed person no longer needs to fulfill the clearing obligation. We mentioned earlier, clearing obligations target transactions between prescribed persons, as well as transactions between prescribed persons and financial services providers. If one party does not meet the clearing threshold, is there still a clearing obligation? If either party fails to meet the clearing threshold, or has issued an exit notice indicating they don't meet the clearing threshold, then there won't be a clearing obligation for that transaction. Why? Because the purpose of mandatory clearing is to control systemic risk, and it targets transactions where both parties are larger, more significant participants in the OTC, over-the-counter derivatives market. Not meeting the clearing threshold means the transaction scale isn't large. Here's a simple table to make it easier to understand when there are clearing obligations. Let's first look at transactions between prescribed persons. Transaction 1. If both parties exceed the clearing threshold, there will be a clearing obligation. Transaction 2. If one party doesn't exceed the clearing threshold, there won't be a clearing obligation. Next, transactions between prescribed persons and financial services providers. Transaction 3. If both parties exceed the clearing threshold, there will be a clearing obligation. Transaction 4. If the prescribed person doesn't exceed the clearing threshold, there won't be a clearing obligation. Why are there no threshold requirements for financial services providers? Because they are mainly global systemically important banks, which are large institutions, so a 20 billion threshold is insignificant for them. Lastly, transactions between prescribed persons and ordinary companies. For Transaction 5 and Transaction 6, regardless of whether both parties exceed the clearing threshold, there is no clearing obligation. Why? Because the OTCD clearing rules only apply to dealer-to-dealer transactions. Ordinary companies are not prescribed persons, so they are not within the scope of regulation and do not need to bear clearing obligations. Remember, the OTCD clearing rules only apply to transactions between larger and more significant participants in the OTC derivatives market. These transactions may cause systemic risks, so they need to be regulated. So, are there clearing obligations for OTC, over-the-counter derivatives transactions overseas? In fact, the Hong Kong SFC Securities and Futures Commission has recognized over 30 jurisdictions, and the regulations and requirements for clearing obligations in these jurisdictions are quite similar to those in Hong Kong. Suppose there is a transaction involving specified OTC derivatives that is conducted in one of these recognized jurisdictions and is cleared through a central counterparty. In that case, there is no need to conduct clearing in Hong Kong again. This is called substituted compliance. When conducting specified OTC, over-the-counter derivative transactions, what are the situations that can exempt specified entities from fulfilling clearing obligations? First, if the transaction is with an exempt affiliate, then there is no clearing obligation. Do you still remember what an affiliate is? It is another company within the same corporate group. Simply put, if you conduct transactions with an internal party that doesn't have clearing obligations, you don't have clearing obligations either. Second, if the transaction is recorded in the books of the prescribed person in another jurisdiction that has been exempted, then there is no clearing obligation. For example, a company operating in Hong Kong and the UK records a transaction in the UK's books, and the UK is an exempted jurisdiction, then there is no need for clearing in Hong Kong. Third, if the transaction has been entered into by a third party on a multilateral basis, with the aim of reducing operational or counterparty credit risk for the parties, it's called multilateral portfolio compression exercise. And there is also no clearing obligation. Multilateral portfolio compression exercise means reducing risks by consolidating or offsetting transactions with similar elements to simplify the portfolio. What is an example? Assume there are three financial institutions A, B, and C. They have many OTC derivative transactions amongst themselves, where A owes B $1 million, B owes C $1 million, and C owes A $1 million. Through multilateral portfolio compression exercise, they can directly offset debts against each other, simplifying the debts and reducing risks. When conducting OTC, over-the-counter derivative transactions, it is also necessary to keep records related to clearing. From the date the transaction ends or matures, related records must be kept for at least 5 years. Regardless of whether these transactions are partially or entirely conducted outside of Hong Kong, and regardless of whether the counterparty is located within or outside Hong Kong. What might be the consequences of violating the OTCD, over-the-counter derivatives clearing rules, such as failing to clear transactions in a timely manner? The SFC, Securities and Futures Commission SFC. The SFC is empowered to bring licensed corporations that breach the OTCD clearing rules before the court of first instance. The court may impose a maximum fine of 5 million Hong Kong dollars. In addition, the SFC may also impose disciplinary sanctions in response to the violation. In the final part of Chapter 4, the main discussion is on the detailed conditions for the establishment and operation of OFCs, open-ended fund companies, as outlined in the OFC rules. At the very end of Chapter 3, we introduced OFCs. Does everyone still remember what an OFC is? First, it is a type of collective investment scheme, which means it manages and invests by pooling funds from multiple investors through professional investment managers to create value and returns for shareholders. The investors' funds are combined to form a common investment portfolio, which is an investment fund. When it is registered in Hong Kong in the form of a limited liability company, it is known as an OFC. Usually, setting up a company is primarily for conducting business, engaging in commercial activities, selling products or services. But that's not the case for OFCs, as they act as investment vehicles managing investments for the benefit of shareholders. So, remember, an OFC is an investment vehicle in the form of a company. As mentioned earlier, Hong Kong is now trying to attract businesses and talents, so it allows overseas OFCs to redomicile to Hong Kong. So, what are the characteristics of OFCs, open-ended fund companies? First, exempt from profits tax. Second, limited legal liability. Shareholders' legal liability is limited to the unpaid amount of the company shares they hold. That is, shareholders' liability is limited, so their maximum loss is usually only limited to their investment amount, not involving other personal assets. Third, variable share capital. For a typical private company, increasing or decreasing share capital requires shareholders' resolutions and cannot be easily changed. But the share capital of OFCs is variable. When investors want to purchase more fund shares, the company can issue more shares, and when investors want to redeem their shares, the company can repurchase these shares. OFCs can flexibly adjust their capital according to market needs. Fourth, they can issue more than one class of shares. Different classes of shares can have different rights. For example, voting rights and the power to distribute profits can be different. Fifth, basically, shares can be freely transferred. OFCs have fewer restrictions on share transfers, but it is not completely unrestricted, which will be discussed in detail later. Sixth, OFCs must maintain a register of shareholders in Hong Kong for inspection by relevant parties. Seventh, like private companies, shareholders holding 10% of the total voting rights can request a general meeting of shareholders. Eighth, an annual report must be provided to shareholders free of charge every year. What rules and codes in Hong Kong regulate OFCs, open-ended fund companies? In the exam, you must know. First, the Securities and Futures, open-ended fund companies, rules, commonly referred to as the OFC rules, are subsidiary legislation. If you do not comply with the legislation, you may be prosecuted and need to bear legal consequences. This subsidiary legislation specifies how to establish and operate OFCs, reporting and corporate governance requirements, powers of the SFC, Securities and Futures Commission, etc. Second, the Code on Open-Ended Fund Companies is a set of rules established by the SFC and is not a piece of legislation. Although violating the code is not illegal and will not result in prosecution, the SFC may reconsider whether the company or licensee meets the fit and proper requirements and should continue to be registered as an OFC. This code applies to both public and private OFCs and stipulates the powers and responsibilities conferred on different individuals. So in Chapter 4, what we will mainly talk about is the first kind, the OFC rules. Let's see what impact this subsidiary legislation has on the structure and operation of OFCs. Get ready, let's get started. How do you register and form an OFC, open-ended fund company? In this section, we will talk about how the process is done. First step, submit specified details and fees to the SFC, Securities and Futures Commission. This includes the name of the OFC, the address of the registered office, as well as the identities of the directors, investment managers, and custodians. After the SFC receives the information, it will consider whether to accept the registration. If the SFC accepts the registration, all documents and fees will be handed over to the registrar for registration and establishment. The registrar needs to maintain a public register, providing the public with access to the details of OFCs. Once registered and established, OFCs, open-ended fund companies, must comply with the provisions of its instrument of incorporation. What is an instrument of incorporation? The instrument of incorporation is similar to a company's articles of association, a document that regulates the operations of OFCs, including administrative matters such as procedures and notices for calling meetings, rights attached to shares, etc. Even though OFCs have the capacity to enter into contracts, they are still subject to the provisions of its instrument of incorporation. When an OFC engages in unauthorized actions, shareholders have the right to commence proceedings to prevent it from continuing improper actions. If an OFC enters into a transaction with a third party that violates the instrument of incorporation, as long as the third party is dealing in good faith, it does not invalidate any legal obligation. This means that even if the actions of the OFC exceed the scope of authority granted by the instrument of incorporation, the third party can still demand that the OFC fulfill its obligations under the contract, and it will not be invalidated because the OFC violated the instrument of incorporation. For example, if the instrument of incorporation stipulates that the company cannot engage in transactions exceeding a certain amount, but the company's investment manager signs a contract with an investor that exceeds the limit. If the investor is unaware and is dealing in good faith, even if it violates the instrument of incorporation, the legal effect of this transaction remains valid. In other words, the investment manager and the company are still liable for the transaction. At the same time, shareholders can use legal means to prevent or correct the company's actions that violate the instrument of incorporation. Let's talk about the share capital of OFCs, open-ended fund companies. One of the features of OFCs is that they can issue multiple classes of share capital. Different classes of shares can have different voting rights and profit distribution rights. The instrument of incorporation will determine how many types of share capital there are, as well as the characteristics of each type of share capital. Moreover, the characteristics of these shares can only be modified according to the instrument of incorporation. According to the OFC rules, the shares of an OFC can be transferred, but the share transfer must be completed through formal procedures, such as submitting an instrument of transfer to the company. OFCs have the right to refuse to register the relevant transfer. For example, if a share transfer will result in the transferor or transferee holding shares below the required minimum holding amount, the company may refuse such a transfer. OFCs, open-ended fund companies, must keep a register of shareholders. What is a register of shareholders? It records the information of the shareholders of the OFC, including shareholder names, the number of shares held, the dates of becoming a shareholder, and cancellation of shareholders, etc. It can serve as proof of a shareholder's ownership of shares in the OFC. If a share transfer is accepted, the OFC also needs to register the transfer in the Register of Shareholders. Where is the Register of Shareholders kept? Generally speaking, the shareholders' register is kept at the company's registered office, or it can be kept at another location in Hong Kong. Take note that you need to notify the registrar in advance before it can be kept in a location other than the registered office. The register of shareholders must be open for inspection to facilitate any shareholders of the company's investment manager, the company's custodian, and the SFC Securities and Futures Commission to review the information of the company's shareholders. Who can call a general meeting of shareholders in an OFC, open-ended fund company? The first option is the directors, as the OFC rules grant this right to the directors. The second option is shareholders who hold at least 10% of the voting rights. For general companies, only a minimum of 5% of the total voting rights is required, but the requirement for OFCs is higher. These shareholders have the right to request the directors to call a general meeting of shareholders and to include a proposed resolution in the general meeting. Like other companies, OFCs need to issue notices before holding a general meeting of shareholders. The notice period for a general meeting cannot be less than 14 days, or a longer notice period specified in the instrument of incorporation. In other words, the notice period must be at least 14 days. If the proposed resolution involves the appointment or removal of directors, or the removal of auditors, etc., a special notice must be issued, with a notice period of not less than 28 days. As we mentioned before, generally speaking, the shareholders of a company can participate in and intervene in the company's activities through resolutions. A passed resolution is a formal decision of the company and is a legally binding statement. There are three methods to form a resolution: written resolution, special resolution, and ordinary resolution. The resolutions of OFCs, open-ended fund companies, are also divided into written resolutions, special resolutions, and ordinary resolutions, but there are slight differences from ordinary companies in terms of requirements for promoters, content of the resolutions, and notice periods. Ordinary resolution: it is passed by shareholders attending the general meeting, with over 50% of the votes. It is usually used to handle standard affairs in the company's daily operations. A notice period of not less than 14 days is required to notify shareholders to attend the meeting. If it involves removal or appointment of directors, or removal of auditors, a special notice of not less than 28 days must be issued. The second type, special resolution, it is also passed by shareholders attending the general meeting and requires more than 75% of the votes to pass. It is mainly used for very significant matters, such as company liquidation, modification of the instrument of incorporation, etc. It also requires a notice period of not less than 14 days to notify shareholders to attend the meeting. The general meeting of shareholders of OFCs can be initiated by directors and shareholders who hold at least 10% of the total voting rights. A written resolution does not need to be conducted at a general meeting of shareholders. The written resolution of an OFC requires initiation by directors or shareholders who hold at least 5% of the total voting rights, and it needs to be submitted to all shareholders for signature confirmation. The written resolution needs to be passed by all shareholders. Written resolutions can not only decide simple company matters, such as general administrative policies, but can make any decisions, i.e., all types of resolutions, including ordinary resolutions and special resolutions. Unless it involves the removal or appointment of directors, or the removal of auditors, written resolutions usually do not require a notice period. We mentioned earlier, all resolution matters of OFCs, open-ended fund companies, can be decided in the form of written resolutions. Written resolutions must be proposed by directors or shareholders with not less than 5% of the voting rights. Alternatively, they can be proposed by shareholders holding a percentage specified in the instrument of incorporation. Written resolutions require signatures from all shareholders for approval. For OFCs, written resolutions are very important. Once a written resolution is passed, to whom must the text of the written resolution be submitted? It must be submitted to all shareholders, auditors, custodians, and investment managers. They are involved in the daily operations and management of the company, so they have the right to be informed. auditors, custodians, and investment managers. They are involved in the daily operations and management of the company and have the right to be informed, while directors are mainly responsible for the daily operations and management of the company. So, what are the regulations regarding the appointment and removal of directors, custodians, investment managers, and auditors for the operators of these open-ended fund companies according to the OFC rules, open-ended fund company rules? We will introduce them one by one. Let's first talk about how to appoint directors. When applying to establish an OFC, the application documents will already appoint the first directors. If you want to appoint directors later, it depends on whether the instrument of incorporation stipulates that an annual general meeting must be held. If the company is required to hold an annual general meeting, directors will be appointed at the meeting. If not specified, the power to appoint directors is delegated to the directors. Therefore, the directors of OFCs may have very significant powers. As for the removal of directors, it is much simpler. The general meeting of shareholders can remove directors at any time through an ordinary resolution. However, before removing a director, calling a general meeting requires a special notice of no less than 28 days, instead of the ordinary 14-day notice, which we have mentioned earlier. OFCs, open-ended fund companies, are required to keep a register of directors, which is available for any shareholder to inspect free of charge. If other individuals want to view it, they need to pay a fee to do so. What should be done if there is a conflict of interest between a director and the company in the transactions, arrangements, or contracts made with the company, meaning there's a conflict of interests with the company? The director must declare it to the other directors as soon as possible. If they were aware beforehand, they should make the declaration before entering into the transaction. If they discover it after entering into the transaction, they should declare it as soon as possible. In simple terms, it depends on when the director becomes aware. Once they are aware, it's best to make the declaration immediately. What is the role of the custodian in an OFC, open-ended fund company? The custodian is responsible for safeguarding all assets of the fund, whether it's cash, securities, or other investments. They are kept by the custodian. Therefore, the custodian is responsible for monitoring cash flows, handling transaction settlements, and dealing with income distributions, ensuring the security and compliance of the fund's assets, assisting with financial reporting, etc., and plays a very important role. How is the custodian appointed? In the company's application documents to register as an OFC, the first custodian is already appointed. If they want to appoint a new custodian in the future, the directors will make the appointment. Take note that the directors must obtain prior approval from the SFC, Securities and Futures Commission, before appointing a new custodian. When the custodian ceases to serve in the capacity of a custodian, a statement needs to be made, indicating if there are any circumstances that shareholders or creditors should be aware of. If there are, these circumstances must be disclosed. After completion, provide a copy of such statement to the SFC. An OFC, open-ended fund company, is a type of collective investment scheme, mainly managed and invested by an investment manager, so it is also a key role. The OFC rules stipulate that an OFC must have an investment manager providing asset management, that is, responsible for managing the fund's investment portfolio, including formulating investment strategies, executing transactions, etc. Therefore, the investment manager must be a professional individual or institution, and needs to be licensed or registered for Type 9 regulated activity. How is the investment manager appointed? Similarly to the custodian, the first investment manager is already appointed at the time of the company's establishment. If you want to appoint a new investment manager in the future, the directors need to obtain prior approval from the SFC, Securities and Futures Commission, before they can appoint a new investment manager. An OFC, open-ended fund company, must appoint an auditor, which is also appointed by the directors. There is no need to obtain prior approval from the SFC, Securities and Futures Commission, but the SFC must be notified after the appointment. The removal of an auditor is the same as that of a director, and it can be done at any general meeting through an ordinary resolution with a special 28-day notice period. If the auditor wants to resign voluntarily, they can also submit a special notice to the company. When the auditor no longer serves in the position, like the custodian, they need to make a statement explaining if there are any situations that shareholders or creditors need to be aware of. If there are, these situations must be disclosed and provide a copy of such statements to the SFC. What powers does the appointed auditor have? First, they have the right to access information related to the execution of their duties, including accounting records. Second, they have the right to make inquiries to senior officers of the OFC, including directors, investment managers, etc. Additionally, they can also make inquiries to the company's custodian and the person responsible for the company's accounting records. Every fiscal year, the directors of OFCs, open-ended fund companies, need to prepare and publish an annual report. In addition, the directors also have the responsibility to provide a free copy of the annual report to shareholders who request it. So what information must be included in the annual report? First, the financial statements of the OFC. Second, the auditor's report on the financial statements. The OFC rules, open-ended fund company rules, sets out the matters on which an auditor must report and the matters it must investigate in order to make its report.